happening. It's Credit Suisse is about a private bank, a wealth management, and asset management. The rest of it, is important, but is not vital, and that's clearly what they're showing here. The amount of capital they're putting in investment banking, they're hiving off the successful glory bits of stateside stuff. That's where the money still is. The European side, not so much. That's going to get withered on the bone.
Marcus, Credit Suisse is its own animal. It has its own pain. It has its own story, but it is within the microcosm of the European banking system, which faces a sort of regime change today, potentially, if the ECB doubles the deposit rate, if they double the benchmark rate. They've been used to the highest levels in more than a decade. How much does that change the scenario in a positive way for banks that have been looking for higher yields, higher rates for a very long time?
Difficult one. Not very much. I mean, especially if it causes a recession, which is quite likely, I think, in my mind, that we're already probably in a recession in Europe, and it's going to get worse. So hiking interest rates and doing some other things as well. I think it's the other bit, the complex monetary plumbing bit, which is these excess reserves. A lot of banks borrowed up to 2 trillion euros at as low as -1%. They've got that free money locked in. And as you say, if deposit rates go up to 1.5, they can sit and park their money back at the ECB at 1.5%. What a lovely round trip. That's too generous. And clearly the ECB will want to do something about that. But if they overdo it, they're going to cause a liquidity withdrawal or potential financial conditions nightmare, like we saw in the UK recently, and perhaps a collateral squeeze as well. They may lose control of their money market rates. They could get this very wrong. They could get sued. There's all sorts of things that could go wrong with positive rates for the ECB. Is quite a new world. They are so used to negative rates, they haven't quite worked out what it's like above ground.
Which raises a question about what they're going to do in December, and that's what people are really looking for today at the ECB rate decision, in terms of whether they ratchet back some of their plans to raise rates. Do you think that that's what the market is basically asking for, and that financial stability will be an increasingly pressing concern if they signal an ongoing aggressiveness?
Yeah, I think the answer to this all lies, as ever, not with the ECB, but in the Federal Reserve. What the Fed do on November 2nd is key to everything. If the Fed do slightly pivot or say that the next hike won't be something like another 75, it gives the ECB the freedom they so need and want to perhaps only do 50 in December, and probably will stop it either there or very soon thereafter. They will talk a bigger book. They have to keep that euro buck above parity. It's just gone back above, first time for quite a while. They'll want to keep it above parity, and therefore they'll want to keep talking, but they really want the Fed to ease off.
You'd have to imagine, Marcus, by the time we get to December, there's a forecast that spouts out recession. Isn't that? Is that avoidable?
No way. I think absolutely. UK, Europe, they're already in recession in all but name, and it can only get worse the more they hike interest rates, let alone talk about withdrawing stimulus too hard. They get the quantitative tightening wrong and all this reduction of excess reserves. A world of pain is coming.
Marcus Ashworth, thank you, sir, out of London. That's the problematic view of things, Tom, when it comes to the ECB. The fact that their base case doesn't include right now a recession in the Eurozone. Next forecast, I believe, come in December. And when they sit down in December, Tom, you'd have to imagine there's some form of downturn, some real downturn in the outlook. And how do you hike again 50, 70 basis points if that's the case?
I was remiss, John. I didn't look at this when I came in this morning, and it is a Bloomberg Financial Conditions Index, which I've mentioned a number of times. England and America are very close, and they've improved here over the last number of days. ECB is stunningly different. This is a different press conference than what we're going to see from Chairman Powell.
There is one really big piece of good news, though, in Europe when it comes to the gas price story. Lisa, is so much better than it could have been at this time of year, primarily because it's been warmer than most people thought it would be.
And this is what I'm struggling to understand. At what point is this a positive development that has really fully been bled through into markets versus what everyone seems to be saying, just wait until actually the winter comes, because it hasn't gotten cold yet. And I was reading a story about daylight savings time being actually a nightmare for the European region because people turn on their lights earlier, and that uses up more energy. There are all sorts of things that people are looking for. I know you look skeptical, but these are some of the things that are like,
I've been looking forward to getting rid of that for a long, long time, haven't you?
I wonder how much pressure there is. Yeah, I mean, I wonder how much pressure there is this time from an energy perspective, because it creates a little bit more of a difficulty.
We fall back.
You fall back.
We fall back.
Oh, of course.
We spring forward.
And you spring forward.
Thank you.
That's right.
It's my value add for the day.
We'll all remember that, Tom. Thank you.
It's my value add.
past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
3 hours away from the opening bell, here's the price action for you. Starting with the equity market on the S&P 500. Futures just about positive on the S&P. Let's call it unchanged. On the Nasdaq right now, we're negative 0.5% on the Nasdaq 100. Meta is down and down hard, but like yesterday, it's not bleeding in a major way. We're down about 19% on Meta. Yesterday, we were down hard on Alphabet, call it Google, Tom. Down hard on the likes of Microsoft. We were off by almost 8%. But as I say, if you strip it out, if you equal weight that S&P, we were positive yesterday, Tom, and I think that might be a surprise for some people out there.
You followed this closer than me, but there's got to be a separation here. This is about Mr. Zuckerberg, right?
Oh, without a doubt.
It's like the Mustang with the sink walking into Twitter. Google's about Google, right?
Sheryl Sandberg has left. Facebook is kind of a mess right now. The outlook, they're investing in a very uncertain future, Bramo.
She's got the Bramo
the metaverse, the rebrand. Take your pick.
Well, how much is this really the push-pull of the negativity? Yes, of Meta, Facebook has its own challenges, but we're seeing the same thing across the big tech names that have reported. How much is this the specific situation of FX headwinds and an economic downturn on one side, and then the step down, the potential for the Fed to not hike rates quite as much as people had expected on the other, providing optimism to the other sectors? It's the push-pull.
I thought Neil Dutter of Renaissance Macro was just awesome yesterday. Sat in that chair, and he just said, step down. It's implicit in the dot plot from the Federal Reserve. This is not news. Why did you need a journalist at the Wall Street Journal to write this up for you and summarize what people have already said and what is in the guidance?
I could not agree with him more, and you've raised the issue about how strange it is that we seem to be agreeing.
John mentioned this before air. John and I usually don't talk before air, but, we spent 30 seconds today catching up. And, John, you mentioned it. Everything in the S&P looks good versus the tech challenges that are out there. Caterpillar just out. I'm sorry. Caterpillar's not a tech company, and they're up nicely. They go from a 197 up near a 200. A little bit of a lift there on a CAT after earnings.
EPS 395, the estimate 318.
Pretty good.
That's a big beat up.
Maybe that's what we're going to see. Let's do this. Let's dive to the ECB now. I'm going to ask a couple questions. You can get out of the way of John and his real expertise on this. Christian Scholz is a Citigroup, the Deputy Chief European Economist. Christian, I mentioned earlier the fancy math of the Bloomberg Financial Conditions Index for Europe. It is extremely challenging. How much will Christine Lagarde's press conference be treated today, touched today, by the grim financial conditions of Europe?
Well, it will play a role, I think. I don't think it will have much of an impact on the rate path, on what Christine Lagarde's going to decide and her team are going to decide today, 75 basis point rate hike, or what's going to follow on later. But it will play a role in how they think about reducing the balance sheet, because that is clearly the next thing that's going to come up. That's going to be in focus, I think, also in the press conference today. And that's where they really need to be careful to not make things even worse on the financial conditions side. Obviously the Italian question, but there's many other issues in the plumbing of the financial system that need to be dealt with.
Sounds like a movie. The Italian question is, well, John, jump in here on the balance sheet.
Well,
You're
I think
expert on
beyond
this.
the balance sheet, Tom, the Italian question right now, if you want to deal with that, Christian, it's the Italians asking the questions, not the Europeans asking the questions of the Italians. You've got the new Prime Minister essentially, and not subtly, going after the ECB about hiking into a downturn and the pain it could cause, backing away from bond buying. Christian, how do you think this ECB will grapple with a different kind of politicization?
Well, they've created a tool, the TPI, the Transmission Protection Instrument, in order to deal with spread widening where it's not fundamentally warranted, so where it's not caused by a policy error that governments themselves need to fix. That is a bit of a warning to this Italian government, not to play by the rules, but it's also a guarantee that if they do, the ECB will be on their side. Will it be enough if trouble really starts hitting the proverbial? We are a bit skeptical. It's big on paper, this tool, but the mechanism of actually activating it and everybody agreeing on it, we think is very difficult. So it's clearly a very, very difficult situation, but it starts with Italy itself. They have to play by the rules.
With that in mind, is it too early to discuss QT at this meeting?
QT will inevitably have to be discussed and will have to be decided and will have to happen the minute the ECB moves beyond neutral on the policy rate, because you cannot have the policy rate being restrictive and or stepping on the brakes and at the same time having a balance sheet setting which is still supportive to the economy. So at that point, the ECB is going to have to start QT. We don't think that the ECB will reach restrictive territory before the start of 2023. So there's still a bit of time, and with all the complications, they better take their time in thinking about it. But come, say, April next year, they will be reducing their balance sheet. And come December, they'll probably decide about this. And today, they may even hint when they will do this.
They will plan to start that in April. They will plan to continue following the plan. But right now, according to their plan, there will not be a recession in Europe, even though every major Wall Street bank and beyond seems to think that there will be. Do you expect them to revise that expectation today?
Well, today is obviously not a meeting with new forecasts. They clearly signal that things have played out worse than they perhaps expected in their last set of forecasts in September, which will signal that a recession will probably be part of the base case in December. We've always said that they won't get very far in their rate hike cycle because of this, but at the same time, inflation is in double-digit territory. We'll see in the next few days where it's going next. It is broadening. Demand seems to be recovering too fast for supply to catch up. There is a case for the ECB to hike into a recession, of course, and I don't think they'll let a recession of, say, the garden variety stop them.
You know, Tom, I do wonder how much some of the American tourists end up being part of the demand story, given the fact that everyone and their mother seems to be going over to Italy.
Just as a quick aside here, but I think Paris is traditionally 17%, 20% of French GDP, and then all of a sudden it was 25%, then it's 27%. With the new tourist boom, I wonder if that tips over 30% of French GDP.
And if you look at all the airlines, September and October is the new summer just because people can work remotely. I wonder, Christian, from that perspective, some of the gains that you've seen in the recovery, does this make the ECB's job harder? That if they are not aggressive enough, you end up with inflation that is more persistent, and you end up with market vigilantes coming out and penalizing the ECB for their actions?
Indeed, there is a strong consensus, at least in parts of the, among observers, that the ECB is behind the curve, that it failed to realize that, all the stimulus that the government's injected in the economy during the pandemic was going to have some impact on, a strong impact on demand when supply couldn't recover quickly enough, and that supports inflation, and that raising interest rates earlier maybe would have made the whole process a little smoother. I think, of course, we all agree that really most of the inflation has nothing to do with the European economy. It comes from external. It comes from Mr. Putin's war in Ukraine and everything that happens around energy, which the ECB cannot do anything about. But clearly there is a rise in inflation expectations, which we observe. If the ECB doesn't react to that, is effectively lowering real interest rates, and that would support demand into a supply crisis, which really can't be the ECB's intention at the moment.
Hey, Christian, thank you. Christian Schultz there of Citi. I want to go back to the earnings from Caterpillar out just moments ago. Third quarter adjusted EPS 395, the estimate 318. This was a number that jumped out for me, Tom. Machinery, energy, and transportation revenue, $14.28 billion year over year. That is plus 22%.
Yeah. And you see that in organic revenue as well. We've had out here, and this is a busy day with 20% of the market cap, Apple, Amazon later, Honeywell, Southwest Air, Caterpillar, picking them out randomly as well. John, add them all together, they make up 11% of Apple's market cap. I never would have guessed that.
Okay, but something's changed with Facebook. Did you notice that Chevron and Exxon have bigger market caps now with Facebook? That's a change, Tom. That's a big change. And if you think about where the excess has been...
Many would say they should.
Where the excess investment has been for the last 10 years, it's been in technology. So if you think about where the recession might be, it's going to be the investment made in the last 10 years in places like that. Where hasn't the investment been? The CapEx hasn't been there in the same way in the energy names for the last decade.
Paul Sankey's led on that. Paul
Sankey, Jeff Curry, Javier Blas, they've all made the same point.
And you wonder with the durability of energy. I'm hearing most of the sell side, the zeitgeist, Sam Stovall as well, saying energy is something still that's underinvested, even with the rush to 120 earlier.
Even in the face of recession risk. Lisa, that's what's remarkable about that energy call, even in the face of recession risk.
Yeah, there's a structural need to invest in some of these areas. Your point, though, about the fact that tech was the leader, tech were the names where people would actually invest. Now we're seeing that really punctured. Just to give you some sense of scope with Meta, right? Facebook. Their value, their market value has collapsed by $520 billion just in the past year alone. And they're now below the level of the 20 largest U.S. companies, trading at a 50% discount to the NASDAQ 100. Just to give you a sense, that is the most ever with respect to the discount.
I believe that drop is almost double the value of Cat, Honeywell, in a small Southwest Air company.
So, John, this is a reason why I wonder, can these things happen in isolation? Or is there a broader market ramification that we might not have felt yet, especially if it's not alone? It might be idiosyncratic features for each of these tech companies, but the investment was done during a time of much cheaper financing and much greater ambition for some of the tech names that are finding themselves in a new environment.
And cheaper labor, too. Think about where the capital was going. It was going to food delivery.
$30 salads.
Cheap car drives. Cheap taxis, Tom. I mean, sure, it's ridiculous. But, Tom, that's where the investment has been. This is why Jeff Curry of Goldman came out months and months ago and said, this is the revenge of the old economy. Underinvested, and this is the revenge right here on the screen. You see it play out. Look at the year-to-date performance of tech. Look at the year-to-date performance of, say, energy.
What I see, I don't have it in front of me, but those organic revenue, remember organic revenue was a GE thing, it was a Jack Welch thing. Now we're seeing it everywhere. And the nominal GDP pop we've seen with inflation gives you buoyant organic revenue. And the question is what happens? And the answer is like Coca-Cola the other day. Pricing power is in place, at least for now.
Still an inflationary world, Tom? Not a disinflationary bust yet? Is that
well,
for next year?
Don't tell that to the housing market, but
I know, that's brutal. We'll talk about that later. Futures right now unchanged on the S&P. On the NASDAQ, we're negative by about 0.6%. Coming up, Gene Tenuto, 7:30 Eastern Time. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank set to look past growing fears of a recession today. It's expected to raise interest rates by 75 basis points for the second time in a row. The ECB is trying to quell inflation that's running at almost 10%, 5 times the ECB's medium target. The Biden administration has been forced to scale back a plan to impose a cap on Russian oil prices. That follows skepticism by investors and growing risk in financial markets. Instead of strangling the Kremlin's oil revenues by imposing a strict lid on prices, the U.S. and EU are likely to settle for a more loosely policed police cap at a higher price than once envisioned. Meta CEO Mark Zuckerberg asking investors for patience. The parent of Facebook is spending billions to pay for its version of virtual reality at a challenging time for digital advertising companies. Meta's shares fell more than 20% after it gave a disappointing quarterly revenue outlook. Samsung Electronics has named J.Y. Lee executive chairman of South Korea's largest company, Lee has been expected to take over the post after his father died in 2020, but the move was delayed by corruption investigations and 2 stints in jail. Among other things, Samsung is the world's biggest chip maker. And going into the midterm election, the American middle class is facing the biggest hit to its wealth in a generation. Still, it's also richer than it's ever been, thanks to a decade of cheap money. That's a conclusion of a Bloomberg News examination that paired new wealth data with an exclusive Harris poll of 100 million adults. Hear more on that story with Bloomberg's new Big Take podcast. There's new episodes every weekday morning. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
we're not going to get the full capitulation from companies on 2023. We think it's just going to take longer. We've written about that quite a bit. You read our research, so you know how we're thinking. We're still bearish in the intermediate term. We don't think the bear market's over, but we do think this tactical rally is going to be big enough to try and pivot and trade it. For those clients who can do that.
Awesome to catch up with Mike Wilson and Morgan Stanley just yesterday on this program, live from New York City this morning. Good morning. Here's the price action for you on the S&P 500. Futures unchanged. A defining characteristic of the last couple of days is that you get big tech, some names getting absolutely hammered, and this market's still holding up, particularly if you go equal weight and strip out the big weightings of big tech. Positive yesterday on the S&P 500, despite the fact that the likes of Alphabet and Amazon and Microsoft rather got absolutely hammered, Tom. Microsoft down by almost 8%, Alphabet down 9% yesterday, and Facebook this morning, if you want to look at Meta in the pre-market, down more than 20%. Just a brutal morning for Meta, and you wouldn't guess it, would you, looking at the equity market this morning?
No, you wouldn't, because we've seen some good industrial earnings, people that are not techie and not VR and the rest. I don't really understand it. I'll let you go there. What I'm going to go to now, and we do this with Mandeep Singh, Senior Technology Analyst at Bloomberg, really encyclopedic on this, is Mandeep, I looked up at Home Depot, and if I want to go out and buy a sink and walk into Bloomberg surveillance with a Kohler Memoir sink today, it'll cost me $271.13. Why is Elon Musk carrying a Kohler's Memoir sink into Twitter?
Well, I think what he's trying to suggest is, look, he's ready to close the deal, and probably, he will be part of how this thing shakes out eventually. No one knows, what sort of changes he's going to make, but clearly he has highlighted, things around cost structure and where they could go with the product. So Sync was just a symbol of him trying to suggest that, yes, he's moving ahead with this.
How distant are Amazon and Apple from the follies of Facebook?
Well, so Facebook was self-inflicted. If you look at the print last night, that was okay, in line with consensus. The earnings wasn't bad. It was just the guide around CapEx and the OpEx spend. And what's surprising to me, and to an extent irresponsible on the part of Mark Zuckerberg, is, with any new technology or product, you have an initial launch, you get some market feedback around product fit, commercial success, where are the areas you want to double down on. In this case, he is just doubling the CapEx. Facebook used to have $19 billion annual CapEx. Now he's talking about 34 to 39 billion. And to me, it's just baffling at a time when your top line is decelerating, your business is challenged because of competition from TikTok. I think it's just irresponsible.
When you say competition, this is the key, right? That Facebook is known as the place where grandparents post pictures of their grandchildren for their friends. It's not known as basically the TikTok of the new generation, or even the Instagram, which has been basically fueling them. But even that is losing some of the clout that it used to have to competitors. So at what point is this an existential crisis that really calls into the question the size of this company? And Mark Zuckerberg knows that and is basically burning money to try to figure out what's next.
Well, so I will give them credit that they're trying to, leverage a lot of AI to catch up to TikTok, and a lot of that CapEx spend is going towards data centers. So granted, they're trying to narrow that gap that TikTok has through CapEx investments. That is okay. The problem is, the younger demographic has already moved off the platform, to your point about, Facebook and Instagram losing some of the audience. And with any, social network or a consumer internet company, once you lose your critical users, which the younger demographics are, the others will follow, and then it's, it's very hard to stop. So that's why he's doubling down. But I still think, the fact that he kept highlighting metaverse and AR, VR, and, adding more product SKUs around VR at a time when unit sales are declining for VR is just surprising.
Yeah. And I would say that just from personal experience, it seems like it's TikTok and Snap of the younger cohort. On a broader level, though, how much is Facebook really representing something deeper here about how much money was thrown at certain tech companies that might become obsolete or out of style at a time when they still carry massive clout in the index? Is this the tip of the iceberg in terms of investors withdrawing?
I don't think so. I do think, investments in AI will pay off eventually. You look at a Microsoft or an Amazon AWS, these are secular growth kind of companies. I mean, yes, you will have a digestion phase in terms of cloud spend coming down, but in terms of the runway, this is huge. We will need the cloud infrastructure, for the foreseeable future, 20, 25 years, and until something else comes up. But AI investment isn't going to go waste. The problem is, where do you focus when it comes to those AI investments? And in this case, if it was autonomous driving or something that was more proven or further ahead in terms of commercializing, it's like Alphabet pivoting completely to Waymo and, saying we will double down and we will add, and it just doesn't make sense. You have to do it in, step. And that's the part that I think Meta is getting it wrong.
Mandeep, do you get the feeling that Sheryl Sandberg knew what was coming?
I probably, anytime, a top executive leaves, a CFO or, somebody like Sheryl Sandberg, they're kind of, suggesting to you that
that's a
yes, they're not. And so I would agree with that interpretation.
Just did the chart, John. Facebook down 43% since June 1st.
Oh, it's ugly.
Down 43% from Sandberg Day.
And Mandeep Singh there. You're calling it Sandberg Day?
Sandberg Day. Yeah, I'm making it up as I go.
June. Just brutal.
People know where I am on this. I mean, the day they went public, day they went public, I had David Kirkpatrick and Paul Kudrowski on together. What an honor that was.
Yeah.
And David Kirkpatrick absolutely nailed the success of Facebook. I was wrong. Kudrowski was wrong. Kirkpatrick, the Facebook effect author, nailed it. I wonder what he would say now.
A lot of people enjoying its failure now, Tom.
Yeah.
Talk a lot about TikTok's success. Have you seen how many people are getting their news from TikTok now?
Yeah.
I mean, we're slightly concerned about that, given this company's association with the Communist Party in China.
We're going to stop the show here.
Americans are getting their news from.
We're going to have an internal Bloomberg surveillance show. Welcome all of you to an internal meeting. Should we be on TikTok?
No.
I have people at Bloomberg suggesting to me I should be on TikTok, and I'm like, no.
That app is not going on my phone.
No, I just don't get it.
No interest.
Is it branded destruction? Seriously, Lisa, for us to be on TikTok, hi, the yen is up.
Well, but it's not just about that. And to John's point, it's about the ownership of a company at a time of steepening strains between the U.S. and China. It's discussion about, where the data is coming from, where it's being hosted. And there's this real insecurity about that around one of the main and quickly growing platforms. I will say about Snap, because that's the other one that the kids use, and I will say my kids use, and I see that. It
makes us sound so old now, doesn't it?
I can't even say. I can't take it.
The kids.
I know. I feel like that guy. What's his name? The guy coming in, being like, "Hey kids, how's it going?"
That's Tom these days, isn't it?
My kids are not on Snap. They're not on TikTok. They're
Congratulations!
Not on Instagram.
Oh, you're having a great
What does Tom
parenting
call me?
situation.
Tom calls me young Pharaoh. Every time he says it, I'm just like, that really shows your age.
Well, I will say, young Pharaoh is not on Snap, I don't think. But the question is, Snap didn't report earnings that were that good. They're not getting the ad revenue either that people were expecting.
Don't get me going.
You thinking of going on TikTok?
No, I'm not thinking of going on TikTok. I got people telling me I should be on TikTok.
Who?
No, thank you. Who's telling you that?
Part of my entourage,
Your agent.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Rightly or wrongly, the Fed views the labor markets as the conduit to achieve their inflation objectives.
I think the whole inflation fear is way overdone, and it's starting to leak into the data.
We've not yet seen that turnaround in U.S. inflation that will really get the Fed to actually cut rates rather than just pause the hikes.
Now, the odds of recession are very high, but we haven't seen the whites of the eyes of that recession yet.
I think there's an argument you're starting to price in a mild recession, but you're certainly not pricing in something severe.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The ECB decision coming up later this morning. Big earnings after the close from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures on the S&P essentially unchanged. TK, Credit Suisse in focus, the ECB as well.
Yeah, there's a big day here and a big day for earnings as well, but let's sit on ECB right now. We're going to go to the statement, and I take it, John, again, I'm not expert on this, but this is not just about, folks, what's the rate, 75 beeps or that. Far more than the Fed, this is about a balance sheet analysis.
We need to talk about QT, the potential to wind back that balance sheet. And Tom, I think things get harder as the year progresses for this ECB. 75 basis points today, potentially, but then talking about balance sheet unwind as well, potentially all of this going into a recession. And again, I've said this repeatedly all week. They are set to do this on a week that we've got PMIs in the 40s in the Eurozone.
And you've got energy, as you mentioned, down as well. I mean, and frankly, you've got stability within the United Kingdom, as witness sterling. I haven't looked at it here, 115.61 on sterling, euro, a little bit. It's just a changed landscape from 2 weeks ago.
Without a doubt. The dollar's weaker. Bond yields have backed away from just a week ago. That's given people a little bit more faith in this equity market. But I go back to the ECB. Lisa, 75 basis points into a recession potentially with double-digit CPI, not pretty.
Well, although I wonder if the weakness is actually going to be, if it comes quickly, a benefit to them to be able to hike, have a recession, and then perhaps a clean slate with respect to some of the inflationary pressures, rather than stop and then let inflation run hot and let the bond vigilantes come in and penalize them on the long end and wreak havoc in the bond markets. This is not the same market that it was when the ECB had the luxury of being at negative rates and just sitting there tight.
Outside of the trading floors of Frankfurt, the City of London, Wall Street, trading floors worldwide, if you tune into a show like this, what do you think this sounds like when we start talking about central banks causing recessions? What do you think that actually sounds like. Central banks trying to get unemployment to go higher so they can get inflation lower.
It sounds like a political liability, and it sounds like a
massive.
conversation that's feasible, maybe, on the peripherals of academic esoteric discussions until there's some greater weakness. We're seeing the earnings roll in, and they continue to show strength, at least around the margins. So if you see that strength, that resilience, it's more feasible to say, okay, we still have perhaps the hopes of a soft landing. Maybe we can get to something where everyone doesn't lose their jobs, or a lot of people don't. As you say, as we get further toward that, it gets a lot harder.
I think we're here right now. I think central bankers have got to do a much, much better job of explaining all this. For years, always said it. If you just tuned in and we were talking about bad news being good news, if you were outside of the market, that kind of thing drove you nuts. And this kind of thing, I think, drives a lot of people nuts too. This Fed in the news conference next week, if it's not next week and the months after that when unemployment's climbing, if it's climbing, needs to explain why that is a price worth paying to get inflation lower. And Tom, I think a lot of people are going to struggle with that concept, and that's why politically this is a real problem.
Politically, as you mentioned earlier, it's about labor, and there's been any number of essays out on this. Do the theories that they have work? Richard Clarida, with us on the last Fed Day, made clear the theories aren't there.
I'm going to be controversial here and defend the central banks.
Oof.
I think, yes, I know, and I'm going to say that they have picked up the slack for fiscal policymakers for many, many years. Now nobody has the ability because we have inflation, and that's crimping both of their abilities, and now everyone's throwing it at the Fed, so that's what's happening.
In support of that, Jean Boivin at BlackRock was heated. This is a supply-side analysis, and all of their theories steeped on demand side. Speaking of demand, we were in London for the Queen's funeral, and I was trying to be responsible with my expenses, so I popped up at Liverpool Station. Liverpool Station, the McDonald's there, Liverpool Street.
How much was McDonald's?
It was not as bad as Zurich, because when I go to Zurich and Davos, I want to be responsible there for number 2 value meal.
$15.
We've been talking here about the anti-tech.
I know.
McDonald's, seriously, McDonald's is anti-tech as you can get. They've got a blended organic revenue in America up 6%, and I think they got a blended international up nearly 9% of sales. They're getting pricing power.
Using a smartphone to order McDonald's, Tom.
Well, yeah, I was doing that.
Are the kids doing that?
No, I was at the Savoy, and you could
You were doing that at the Savoy.
Trafalgar Square.
It's a good look.
I was doing it, bring the bag in from Trafalgar Square.
I can actually the ugly American order at the Savoy.
That would be true.
McDonald's coming in on a tray.
They charged a small stocking fee to bring it up to the 24th
I'm sure they did. I'm going to whip through the price action.
Please.
Futures unchanged on the S&P. Going into the ECB a little bit later this morning. Lisa's going to run you through that. That's the equity market on the S&P 500. Need to talk about the bond market too. Yields are higher by 7 basis points, almost close to 4.1%. Need to talk about foreign exchange as well, Tom. The dollar's been weaker. Last few weeks, last few sessions, last week. Euro dollar to see it back with a one handle on euro dollar. That's something, Tom.
And you see it in Damien Sassar's world as well. EM has pulled back here a little bit from crisis levels. One I mentioned is not as Turkey. That's its own story. Renminbi 7.24 yuan per dollar. It's a little better, but these are small movements within the continuum of grim EM.
Well, I can tell you the dollar biting back this morning. The dollar's stronger right now. Euro dollar negative 0.5%. Lisa, going into the ECB a little bit later.
Yeah, let's see what happens about an hour time when we get the ECB rate decision. 8:15 a.m., 8:45 a.m. is the press conference with Christine Lagarde, the president of the ECB. 8:30 a.m., a bunch of U.S. data, including the first read on the third quarter GDP. Do we start to see some strength come back into the market after 2 consecutive quarters of declines? Also, initial jobless claims expected to remain near historic lows. And after the bell, Apple and Amazon and Intel all reporting earnings, a massive day of reporting results. How much do we see some sort of confirmation of what we saw from Meta and some of the other tech names that have reported so far, John?
Lisa Bramberts, thank you. Sharon Bow joins us now, the European equity strategist at Goldman Sachs. Sharon, I want to start with this call from the ECB. We're looking for 75 basis points. There's a big conversation about maybe a recession taking place. Is that an equity market that you want to own?
Yeah, I probably not, actually. In the near term, I think European equities have bounced a little bit. As per earlier comments I heard from Tom, we have seen some of the kind of tail risks related particularly to UK volatility and rate volatility come down. That is great, and I think that's helped with the bounce. But I think more medium term, it's not really a market I'd look to own into a recessionary environment. And we do think there will be a recession next year, along with these tightening rates.
Okay, tightening rates in a recession, how does that lead into your guesstimates forward on what I'm going to call a broad European organic revenue growth? Can companies still deliver not 1, 2, 4% organic revenue, but can they do better a year, 2 years out?
I think actually revenue growth will probably be okay because inflation will probably be staying sticky and high. And companies will pass some of that through, pass some of the cost through. In fact, that's exactly what inflation is companies passing some of that cost through. Probably won't be able to pass all of it through. And of course, not only have you got higher costs coming through, you've also got higher interest rates, you've got higher taxation as well. So I think revenue probably okay, but margins is probably where the squeeze will be.
How much are you getting bullish on European banks? And this is sort of the pain trade always, just simply because rates are finally going up, and that's what they've been asking for a long time.
Yeah, and I think actually banks are, if I'm talking about a European recession, and we are talking about Europe seeing a contraction in GDP next year, you would ordinarily say that's dreadful news for the banks. They're domestic, they're levered companies. And they would obviously be very badly hit if there's a rise in non-performing loans. But I actually think this time around banks could do a little bit better. Interest rates are rising, as you point out, and the last few cycles, interest rates have been very low, often negative in Europe, and that's not the case now. So higher interest rates, I think, really helpful for the net interest margins. But also banks themselves have got better capital now than they've had in the past. Also, I do think unemployment perhaps will tick up a tiny bit in Europe, but the labour market's pretty strong. So even if you get a downturn, a contraction in GDP growth, largely because sort of industrial output, supply starts to come down, etc., I think the employment side of things will look a little bit rosier. And for banks, people generally continue to pay their loans, their mortgages, etc., as long as they have jobs. So they will see a squeeze in their real incomes. That's going to hit them for sure. But for the banks, what really matters is whether people are still paying off their debt. Now, on the flip side, of course, people probably won't take out new loans at higher cost, or they'll try and avoid that. So it's not all rosy for the banks, but I think that relative to previous cycles, yes, I agree, higher rates is helpful.
Sharon, on net, you've said they can be more defensive in this downturn, in this cycle. You and I talked about that last time. Have you seen clients become more receptive to that message? You've seen stocks behave that way?
So the banks have outperformed again recently. Well, they've outperformed the bounce recently. They've been outperforming sector year to date, even though we've seen GDP slide. We've seen, as you mentioned earlier, PMIs in the mid-40s now. You would never have expected banks to have been an outperforming sector into that type of environment. So I do think that shows you can see banks behave a bit differently this time around. Clients, they are naturally skeptical about banks, and absolutely, banks tends to be more of a trade than something you want to hold longer term. But I think the fact that they are paying reasonably good dividends and the fact that they do benefit from higher interest rates, results so far look reasonably okay for the banks. That all provides some reassurance.
That's true of the whole of Europe, I think, not just the banks over the last 10 years, Sharon. Wonderful to hear from you. Sure. As always, Sharon Bell of Goldman Sachs on the financials, going into the ECB a little bit later. TK, I keep saying it because I'm still surprised by it. We're talking about another 75 from the ECB. With the data where it is, I get it, double-digit CPI, but the data's pretty weak in Europe right now, on the other side on output too.
I just don't get it. I don't get it on a nominal GDP basis and also a technology overlay. Does Lagarde come out and say, okay, we're going to dutifully do 75 beeps, and that's it? Does she say that?
They're worried about the second round effects, Tom. You know that from the inflation story. Yes. I get it too, and Lisa, they're worried that this becomes even more entrenched because of the supply side dynamic in the energy story.
Yeah, and not just that, but also some of the potential supply chain disruptions with respect to China and what's going on there. I mean, there are a lot of issues. This is a nightmare for central banks, is this stagflationary environment, and that is what they're all facing off with.
I think Mohammed called it a quagmire of stagflation.
That's
like a toxic brew.
A toxic brew.
It's a toxic brew.
I tell you what, that sounds deeply depressing, doesn't it?
Well,
a quagmire of stagflation.
Yeah, toxic brew. Nodes of concern.
Bramo is becoming more constructive. You notice that, Tom?
Nodes of depression.
A whisper
before she
of
said
optimism.
That. Jeremy Stretch coming up later over at CIBC. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Central Bank set to lift its main interest rate to the highest in more than a decade. It's trying to lower record high inflation. Almost all economists surveyed by Bloomberg predict a second straight 75 basis point hike today. President Xi Jinping says China is willing to work with the U.S. to find ways to get along. The comments came before a possible meeting with President Biden next month at a Group of 20 summit. It signals an effort on Xi's part to maintain ties despite disputes over everything from Taiwan chips to the invasion of Ukraine. Meanwhile, U.S. Secretary of State Antony Blinken is accusing China of undermining the status quo that has kept both nations from going to war over Taiwan. Blinken spoke to Bloomberg in Washington. He said Beijing was trying to speed up its seizure of the island. China and Taiwan downplay the likelihood of an invasion anytime soon. Credit Suisse is planning a sweeping overhaul. It includes a $4.1 billion capital raise, a carve-out of its investment bank, and thousands of job cuts. It's the most urgent attempt yet to repair Credit Suisse after huge losses and management chaos. In breaking up the investment bank, the firm will create a separate advisory and capital markets business that will revive the first Boston branding. And the world's richest man told Twitter employees he does not plan to cut 75% of the staff. Bloomberg's learned that Elon Musk denied the numbers in an address to workers at the company's San Francisco office. Still, the billionaire is expected to cut staff when he takes over the company, causing anxiety among workers. The $44 billion deal set to close Friday. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digital Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify
slide the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
On October 30th, Brazilians head to the polls for a runoff vote between former President Luiz Inácio Lula da Silva and incumbent Jair Bolsonaro. Bloomberg will be live from Sao Paulo as the nation decides on the future of Latin America's largest economy. Coverage begins Friday on Bloomberg, your global news authority.
What's changed is this: the decision by the government in Beijing that status quo was no longer acceptable, that they wanted to speed up the process by which they would pursue reunification.
That was Secretary Blinken, Antony Blinken, sitting down for an audience with Peggy Collins down in DC, TK. Bloomberg's very own. Very, very cool. Just yesterday, an audience with. Do you like that?
Yeah, I think it's important, and he's taking obviously the international view. But right now in Washington, based on the zeitgeist I see this morning, you click inside 2 weeks to an election. It's sort of like the United Kingdom. Maybe we're becoming as focused as the United Kingdom becomes focused.
You mean we're concentrating things a little bit more?
The mind is
not dragging it out
concentrating
for
for
a few
both
months.
sides. Yeah.
Don't we start the presidential race at the start of the year?
You guys do it better. That's all. Well,
it's 2 years long.
Really? Are you just trying to rub it in?
No, I'm trying to
You're
wind him up
living it.
because I know that he finds it ridiculous.
But he could push back and say, you chose to live in this, so here you go. 2 years
Sure,
of joy.
I love it here.
Oh, yeah.
You know I do. I'm very thankful for being a guest of this great country. I've said that repeatedly.
How's the rent search going?
I can talk about the rents in a very different fashion. Rents in Manhattan. Nuts. Honestly, Tom, absolutely insane.
Explain the difference between rents here and rents in London.
Well, the fee model's ridiculous. The idea that you'd pay 1 month rent on a 12-month lease as a fee is insane. And I see a lot more no-fee rentals coming on Street Easy and Zillow. You see much more of that. But the fact that's still a model in New York is, in New York, I just think is unreal. Foreign to me, Tom, foreign. But I am foreign, so.
Oh, yeah, it's okay. Personal finance today on Bloomberg, and we welcome all of you. She's familiar with the rents across the nation. Anne-Marie Horton joins us now, Bloomberg Washington correspondent. Anne-Marie, I know the territory along the Erie Canal of what was industrialized America, coming out of the Mohawk River Valley. There was Carrier in Syracuse. There was a company called Kodak in Rochester, and they are gone, gone, gone. The president will visit that shell of industrial America, and he will try to paint stark relief within the panic. How panicked is the White House? How panicked is the president?
Well, just quickly to John's point, I think rents in London actually are cheaper. To the president's point today, it's pretty astonishing. Less than 2 weeks ago to the midterm elections, they're going to deep blue New York, and he's going to be joined as well with Governor Kathy Hochul, who also had a very contentious debate this week with her Republican challenger. Crime is really becoming a focus in New York. And the Washington Post has a great piece out this morning about talking about the fact that over the last 48 hours, it's become very difficult for the Democrats. They called it a defensive crouch right now. What did you have yesterday? You had the First Lady Jill Biden in Rhode Island. They are really starting to send out these surrogates in places where normally they would have this support already shored up, and also advertising campaign in congressional districts in New York and New Jersey. So that really says to me that they are a little bit nervous, not about maybe flipping some seats, but about holding or potentially flipping some of the seats that were held by moderate Republicans that they thought a month ago they would have easily had in the bag.
Oh, come on. Dr. Biden's in Rhode Island. Dr. Biden's in Syracuse. You know, whatever. Why are they in the states that are a layup?
Well, there are states that laid up because, one, they are nervous, and then, two, some of these other states that are very, very close, neck and neck. You think Nevada, where it really does look like Adam Laxalt has a very good chance of winning that seat from the Democrat incumbent. they do not want the president there because many still view these midterm elections, the president would say it's not, but they are, as many view, a referendum on the current administration. So they want to keep a very large, wide distance from the president and some of his surrogates coming out of the White House.
Anne-Marie, what is the message that Treasury Secretary Janet Yellen is among those campaigning for this administration, given that she is currently, I believe, in Ohio, talking about electric vehicles of all things and economic development?
What the administration is going to try to do is point to the legislative wins they've had, and that started back last summer with the hard infrastructure package. The president recently was talking about it today, how with the prior administration, the Trump administration, it was almost a running joke in Washington, D.C. that every week was infrastructure week, and he was able to cross party lines and get that done. And then this summer, of course, they were able to pass what they're calling the, quote, Inflation Reduction Act, but really that has a lot to do with healthcare and also climate and EV credits and things like that. So she is going to go out and tout that and probably try to make the case that when you have these kinds of bills, whether the U.S. government could then go on behalf of the American people and negotiate your pharmaceutical companies and get drug pricing down, it will help ease inflation. But it'll be interesting because obviously in a place like Ohio, things like inflation, the economy, these are the #1 issues people plan to go out and vote on.
Did you watch the president drive cars really fast with Jay Leno, AMH, last night?
I watched about 20 minutes of it. The cars were very cool. I'll
Jay
say
Leno's
that.
very cool. Did you watch that, Tom?
No, I missed
There was no mission. The car's cool. Jay Leno is cool. What are you trying to say, John?
I didn't say anything. Were you trying to get me in trouble this morning? I didn't say anything. I said Jay Leno was very cool. The
president has a cool
Oh, you're asking me if
Corvette.
President Joe Biden is cool?
Yeah.
Anne-Marie, thank you. Down in PC. I mean, what do you want me to say to that? What do you want me to say to that?
What cars are they driving?
I think a 67 Corvette or something.
That was called a pivot, Tom.
Yeah.
No, it's true.
And I think it was an old Ford SUV that had been converted into an all-electric or something like that.
Can we get back to the election?
Oh, no, please.
With our team
Unless you want
coverage,
to weigh in on whether the
election
president
night.
is cool or not. I mean, by all
No,
means.
the president's not cool for Democrats. I'm looking at the map of the giant Greg Giroux, who's brilliant on this. And they're in New York, they're in Rhode Island, they're not on the Giroux maps. That's not where the tension is for his party. It's the usual ones, California, New Mexico, blah, blah, Maine.
What's the race you're focused on, Tom? Let's get to it. What's the race you're focused on?
I think the race I'm focused on is a broader Senate race. I don't have any narrow ones that I really, I'm like everybody else. I don't want to be a pundit on this. We got the nation's drowning in punditry. Does the UK get like that?
They're drowning in punditry too in the UK.
Yeah.
I mean, how many little elections have we had over the last few years, Tom? Not
I
general
don't-
elections, though.
I just
mean
listened to somebody like Greg
Conservative Party
Giroux.
leadership contest, to
Wasserman
be
over at
specific.
Cook.
I'll be pundit. I think the Fetterman and Oz debate's going to be the debate, but how the outcome of that is going to be really interesting, considering that Fetterman's the incumbent. But it's really sad. I mean, he's recovering from a stroke.
I found that immensely sad as well.
I would agree.
I found that so sad to see him like that.
And how does this really represent the Democrats trying to go up against someone who they're painting as extremist with a candidate who's dealing with his own personal issues that are pretty obvious to people in the audience?
Really sad, Tom, and no doubt it's going to be a focal point for the next couple of weeks as well. In the next couple of hours, we'll catch up with Gene Tenuzzo of Columbia Threadneedle. Looking forward to doing so in the next couple of minutes, actually. And looking at this equity market on the S&P. Futures lift, Tom, by a tenth of 1%. Yields up by 6 basis
Dow's
points.
had a good day.
That member weighting of the Dow probably helps the Dow out.
Yeah, well,
over the
and
last couple
Anaconda
of days.
Copper helped out.
Of course.
Sword fighting. I love this.
No,
This is
well, you know,
verbal sword fighting.
Best of friends.
Dow has outperformed SPX over the last X
Nothing.
number of
Because it's
days.
equal.
How many people are invested in that, Tom?
Tons.
Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Take a look at equity futures this morning and start with the S&P, positive 0.1%. Go to the Nasdaq, tech heavy, down about 0.4%. Could you guess that Facebook is down by 22%? And that's a feature of the story the last couple of days. Single names, big tech, Alphabet, Microsoft getting absolutely hammered. And it's not showing up in the index in a major way. In fact, if you look at the equal weight S&P, Tom, I think that's been the story the last couple of days.
Absolutely the story, and it comes down to buoyant revenue growth and ability to raise prices. We've heard that. Gina Martin-Adams says maybe that will end at some point with Bloomberg Intelligence. But for the meantime, these are good organic revenue growth numbers across a broad section of non-tech companies. And, you know, I don't compare these companies to Apple and Amazon. A guy like Ives will tell us that. Sure. Bloomberg Intelligence. Mandeep Singh will tell us that. We'll see this afternoon. The
bear market in tech continues. Resilient somewhat elsewhere for the last couple of days. Let's see if that continues. In the bond market, 2s, 10s and 30s shaping up as follows. 444.51 on a 2-year. Yield higher by 4 basis points. Everybody talking about a step down in rate hikes. Citi talking about a step down too. Ellen Zentner's talking about that as well. I think most people on board with this idea that you get 75, you come down to 50 and maybe 25 after that. That's what Ellen Zentner and Morgan Stanley are talking about this morning. Hollenhorst at Citi said this.
I love this.
If anything, we see hawkish risk as officials will look to avoid a re-loosening of financial conditions. And that's the interesting point from the team over at Citi, Tom.
How do you do that on Bloomberg Surveillance, folks? You go to the Bloomberg Financial Conditions Index, which shows you a Hollenhorst-like number. John, negative 1.06, make that one standard deviation, and that is more accommodative than where it was 10 days ago.
I want to finish on the euro just briefly and look at euro-dollar going into the ECB, looking for a 75 basis point hike. 8:15 Eastern time is when we get that decision.
And the pressers when?
About 30 minutes after that time.
30 minutes.
Euro-dollar negative 1/3%. And I was just looking at Italian-German spreads. The 10-year Italy
the Italian
trading 222 basis points over Germany on a 10-year maturity. The wides of the year 252. So we've come in, but I think that's probably still an uncomfortable level, Tom, for a lot of people in Europe at about 220-ish.
Yeah, we'll have to see. I stepped on. Don't get me going.
Step down.
I don't like it. It's just, come on.
What
it's
don't
just,
you like
it's a slow down on a rate of change. It's just another marketing thing. Where did it come from? Who do we blame?
Who do you want to blame?
McKee?
I mean, I've been saying
did he invent this?
I can't remember where I got it. I think Jim Bianco maybe said it out on Twitter as well. I think others at Morgan Stanley are saying it this morning. Citi's saying it. Would you like to rebrand it? We can rebrand it if you want. It's a change of the rate of change.
It's just, call it a Newtonian move. You know, something everyone would understand.
That works fantastic
that
on
works,
the south side, Tom. Lisa, what do you make of that? A Newtonian move You going to open that one?
Happy meal and rates? I don't know. I will say a slowdown is not a pivot. That's the Hollenhorst view this morning, which is, and then he uses step down, but in quotes, because he doesn't want to take responsibility for it, I know. We could have him on and hopefully rebrand it. When you were talking, John, about some of the tech names, I want to dig into some of the scope of the moves that we have seen. I mean, just based on Google, or Alphabet, as the parent company is called, and Microsoft, those shares both suffered the biggest sell-off going back to March of 2020 yesterday. They are still down today, so it didn't necessarily free up valuations for people who really don't want to catch a falling knife. And Meta Platforms, I mean, this is just amazing to me. There was a really smart comment on Twitter, a viewer saying, today's Meta is tomorrow's MySpace. How much is that right now, the feeling in markets with shares lower by 23% after already falling dramatically, more than 60% and to the lowest level since 2018?
Like an old museum that no one visits anymore.
Is that what MySpace is?
That's what MySpace is, isn't it?
Like an old museum?
But aren't the pages still there, or were still there?
I never had a MySpace
Exactly.
page.
I don't know if they're still there because it's an old museum that I've not visited
We'll
for a
have
long
to
time.
dig up the archaeological evidence, and we'll share that with you if we can get it later. In the meantime, we are looking ahead to what's going to happen after the bell with Amazon and Apple and Intel. And I put Intel in there because that's also the microcosm of the bigger story behind the chip sector. How much is Apple really going to be the true bellwether? If they're able to be resilient, does that highlight that this is specific stories, Tom, and not necessarily just some sort of broad-based retrenchment from the tech world in general?
Same on Amazon as well, folks. You're going to have some mystery there of how Prime Days, or days plural, did for Amazon, and the last mile of the cardboard box business seems to be a bit of a challenge as well. Right now, Gene Chanuzzo, global head of fixed income at Columbia Threadneedle, with a very smart note encompassing all the econobabble. And Gene, I want to bring it right over to the numbers we're going to see today. What does the Fed do with buoyant U.S. GDP? Recession this, recession that. I'm looking at a 2.4% statistic to see at 8:30 in 1 hour this morning.
Tom, I think it's difficult to call U.S. GDP buoyant when it's been negative for the first half of the year. And we can blame that on different factors that are not related to the consumer. But I think this is actually a requirement if the Fed still has any chance of a soft landing to get some semblance of positive GDP for the third quarter.
Gene, we get so much pushback against this step-down term. Duncan on Twitter, I think the best term is to slow the pace of rather than step down. Do you like that, Tom? Just slow the pace of interest rate hikes. Gene, isn't that decision ultimately going to be at the mercy of the next CPI print in November, going into the December meeting?
It sure is. I think we are getting closer to that point where the Fed can decelerate its pace of hikes, but we're not there yet. And we've seen that the Fed has a pattern of looking at that most recent CPI print. And that last one was sufficiently hot that, 75 basis points still needs to be the base case for next week's meeting. But I think as we go later in the year, there can be ample justification for them to slow down that pace. And I do think that's a meaningful signal because that reduces interest rate volatility, and interest rate volatility has been at the center of financial market weakness this year. So, I think that is going to be a critical step, even if it's not the end of this tightening cycle.
How concerned are you, Gene, about the bond vigilantes coming back in the United States in a way, particularly for 10-year and 30-year denominations, if there is some sort of step down, if there is a slowdown in the pace of rate hikes, even in the face of CPI that still is coming in hot?
Yeah, thanks, Lisa. I'm not that worried about it. I don't think it's a market that has the same vulnerabilities, for example, as we saw in the UK market, where very thin liquidity and some leveraged players at the long end of the curve could really drive those prices and yields to significantly higher levels in a short period of time. I think those dynamics are different. The risk case for the long end of the U.S. curve is if we really start to see aggressive selling in a scenario, for example, where Japan ends their yield curve control. But I still think that's an outside case. And I think for the U.S., the idea of the bond vigilantes coming back, well, it's real, but haven't we seen it this year already?
So do you think that there's already evidence, and enough evidence, that there is some sort of slowdown in the pace of inflation, with AutoNation this morning, for example, coming out and really confirming this view of used car prices coming down, and there's feeling that there's limited pricing power for an increasing number of U.S. companies? It's all bleeding into this feeling that perhaps people have gotten a little carried away with some of their inflation projections, that naturally it will come down a bit more.
I think that's the most important question in markets today. I think there is ample evidence that there is lower inflation in the pipeline, but it's not in the headline figures yet. And I don't think the Fed is prepared to blink when they're barely over their neutral policy rate estimate and inflation at a headline level is still high. So it's coming. We feel like there's a broadening amount of data that support that, whether it be in used car prices, as you suggested, whether it be ISM prices paid, measures from the National Federation of Independent Businesses, and a variety of other things. But it will take just a little bit more time.
Gene, final question then. 10-year last week, on Friday, I believe, was at 4.33. Right now, the 10-year at 4.06%. The 2-year right now at 4.44. On Friday at 4.63. Just want to get a feel from the conversations that you've been having with your colleagues and perhaps clients as well. Do you believe that might have been the high on Friday, or do you think we're still threatening to break beyond and above those kind of levels?
We'll continue to press so long as the Fed is aggressively hiking in these 75 basis point increments. And we're likely to have the three biggest central banks hiking in that magnitude, within the next week. But I don't think we're far away from that hike or that peak, John. And I don't know if we just saw it last week or if we're going to see it in the next few weeks. But, if we plan for our clients over 12 months or beyond, I think these are better. This is a better environment to be adding duration to portfolios, quite frankly.
Gene, thank you, sir. As always, good to catch up, buddy. Gene Tenuta there of Columbia Threadneedle. Thank you very much. Tom, that seems to be the take from a lot of people, that after the 75 at the next week's meeting from this Federal Reserve, we've seen the bulk of the hiking cycle, and you can think about leaning into a bit of duration. I hear that a lot from a lot of people.
Yeah, I'm hearing it too. When's the inflation report, John, you're focused on?
November 10th, I believe.
There is. That's what matters, November 10. Read of the day, Peter Bookvar. We protect the copyright of our guest, Peter Bookvar, over at Bleakley Advisory. John, I talked about this yesterday to someone I ran into on the street. We're not talking about the redo in floating rate paper and in commercial real estate. Everything's about 30-year mortgage. That's what sells on TV. I get that. He brilliantly walks through that transaction of 2 years ago. That's a 3-year piece of paper, multifamily housing, and what happens a year from now, and the math doesn't work.
You know who is talking
Simple as
about
that.
it? She's sitting next to me.
I know. The math doesn't work. Bookvar just nails it. Absolutely nails it.
It doesn't really matter. Just going forward, though, I think that there is this bigger question of how much inflation already is coming down. And you ask about what you look for. It's not going to show up in the CPI reports because it is going to crimp some of the housing demand. We've already seen this, but it isn't going to show up for another year. So how much do you start to feel this subtle feeling, not of transitory, but that the inflation is going to cool a lot faster? And that's what I'm hearing from the likes of Peter Scheer. And that's what we just heard just there.
Do we think we're going to see a substantial disinflation in rents or in home ownership costs?
Well, how are you measuring it? In the official CPI print?
No, you're not. I mean, it's a distortion, but the answer, and we're infected by New York, and I went below 59th Street yesterday, John.
Is this where you had a conversation?
I was shocked.
He had to.
What did you see?
There's a bridge down there, Brooklyn Bridge. I went right by it. It was gorgeous.
We're on 58th. How'd you get into the building?
I had to figure it out, The only way I knew was the McDonald's was around the corner. That's when I saw that.
I thought that was on 57th.
That's on 3rd Avenue. I went below
between 57th
Street.
and 58th.
Yeah. I don't think rents are nationwide. Rents are going to disinflate. Are you kidding me?
That doesn't happen usually. They're not going to disinflate, but the pressure goes off a little bit.
I'm still surprised you actually had a conversation with someone you met on the street.
Well, yeah.
Usually you ignore them and you're really rude and I'm polite.
Security pushes them away.
I'm polite and you shout out, "Get a life," or something like that.
Special moment.
True story.
I know.
True story.
I know.
Get a life. And I'm just sitting there like, thank you so much for watching. From New York, this is Bloomberg.
Tom Keene, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. The European Central Bank set to look past growing fears of a recession today. It's expected to raise interest rates by 75 basis points for the second time in a row. The ECB is trying to quell inflation that's running at almost 10%, 5 times the ECB's medium target. The Biden administration been forced to scale back a plan to impose a cap on Russian oil prices. That follows skepticism by investors and growing risk in financial markets. Instead of strangling the Kremlin's oil revenues by imposing a strict lid on prices, the U.S. and EU are likely to settle for a more loosely policed cap at a higher price than once envisioned. It's Credit Suisse's most dramatic steps yet to repair the bank. It plans a $4.1 billion capital raise, a carve-out of its investment bank, and thousands of job cuts. We spoke with Credit Suisse's CEO.
We want to go through the transformation of the next 3 years with a very, very strong capital base and leave the transformation also with a very strong capital base. It will become profitable definitely from 2024 onwards.
Credit Suisse is trying to restore credibility after a succession of big losses and management chaos. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully. And, the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
also have to be to responsibly manage increasingly intense competition with China. You know, we have to maintain our military advantage, but we're making it clear that we don't see conflict. I've told them that we're looking for competition. There'll be stiff competition, but doesn't need to be conflict.
The President of the United States on the relationship with China, live from New York, counting you down to an ECB rate decision about 30 minutes from now, with equity futures slightly negative on the S&P 500. Have to say, no real drama here on the S&P. Drama elsewhere, though. Meta down by 22%, 22.6% in and around session lows. Credit Suisse down about 12.5%. So, Tom, drama at the single name level this morning, and a little bit later this afternoon you hear from Apple, you hear from Amazon as well.
Yeah, and I don't want to waste a lot of time here, John. We got Greg Villiers coming up, but I'm going to point out that my theme for next year is the great zombie roll-up, and maybe that starts with Credit Suisse today doing its own interior roll-up.
Which is the zombie piece, the piece that gets
They have a bad bank.
spun
They're
off,
setting
or
up
is
a
it
formal, to their credit, they said, look, we're going to do the bad bank accounting, and they're going to throw, part of that's going to go to Apollo, PIMCO, blah, blah, blah.
talk from Reuters of this IPO of the Credit Suisse First Boston? Tom, can you talk to us about that, the heritage of First Boston to make a comeback?
To fossils, of which there are 12 left on Wall Street, it is a magical name. There's no question, the romance of it, and it's literally out of Mad Men. It's literally, I mean, you got to go back to the 50s and the 60s. Okay, they're going to market it, they're going to brand it, but what I would suggest people want to see is results.
Sure.
That's what they
And can we just say we all know some brilliant people at Credit Suisse, and I'm sure this morning's.
Yes.
It's pretty tough, isn't it, when your company goes through this time?
And one of the first people to get behind me in the act I'm doing, folks, is Neil Sauce, head of research for years in economics at Credit Suisse. Right now, also behind us is Greg Villiers with the must-read note from AGF Investments, and he joins us this morning. Greg, I said to them, get somebody who remembers driving by the GE factory in Schenectady, New York, on your way past Utica. There's only one guy we know that remembers Jack Welch's Schenectady, New York. It's gone. Greg, maybe it's the Uticas of America. They're going to go to Syracuse today. Dr. Biden went to Providence as well. Can the Democrats garner votes in the many Utica, New Yorks of America?
Well, ironically, it looks like Democrats who have been entrenched in New England are in trouble. So no, I think we're seeing a total reversal. We're seeing Hispanic voters leave the Democratic Party, go into Republicans. We're seeing a lot of changes from the old rules.
And Lisa, what I think is so important here is this just simple idea of the panic 2 weeks into the election. And what we're going to see day to day here is going to be extraordinary.
Well, and if you look at some of the betting odds, you can see that the Democrats are just dramatically losing seats. And there's a question of how bad of a whopping they're going to take in both the House and the Senate. Greg, with respect to which races you're watching, what's going to be most telling to you in terms of not just whether the Democrats lose power, but by how much?
Yeah, I'm at 17 in the House, and I'm probably on the low side. I might have to revise my final forecast and put it up into the 20s. So many interesting dynamics in this election. Polls show that crime has surged as a big issue. Polls show that abortion is not as big an issue as we thought it might be. Polls also show Hispanic voters are moving to the Republicans. Really interesting stuff. And I do think there's going to be a wicked post-mortem among the Democrats trying to figure out just what happened.
And not to be conspiracy theorist, but I have to go to this because there have been some rumblings around the edges. How concerned are you about election security at a time when it's clear that there are a number of international actors, as well as domestic ones, that want to raise doubts about the institution of the United States?
It's a legitimate fear. There was a break-in yesterday. We don't know the details, so we can't really speculate, but I have a hunch that's probably not the only incident we'll have in the next 2 weeks like that.
Right.
Charges of ballot box stuffing, all of that stuff.
Greg, a real focus on the Democrats here. Let's focus on the GOP right now. How grand old party is the GOP 2 weeks out?
Well, they've got an internal debate to resolve, and that is how much money do we give Ukraine? Kevin McCarthy has had to walk back what he said. I think most Republicans want to continue the funding.
Right.
I would make...
Please, go ahead. I'm sorry. Please.
I'd make this point, Tom. I think one of the sleeper issues, and it involves China, it involves Ukraine, it involves Iran, is a dramatic increase in defense spending. I think we go to $800 billion in this new fiscal year.
Are Democrats and Republicans on board with that jointly, as we see them both jointly with a view on China?
one of the rare issues where you could see a compromise. I think there's unified antipathy in Washington toward China for all of the things that they've done, with whether it's COVID or treatment of dissidents.
Greg, let's say that the Republicans do win both the House and the Senate. What are they going to do with the Fed when they are hiking rates? How much are they going to start pushing back against pretty aggressive tightening in some of the monetary policies, simply because it's going to create some real problems for this economy?
Fearless forecast, Lisa. I think we're going to start to see the Fed really come under intense criticism. We saw yesterday Sherrod Brown, the Democrat from Ohio, with a pretty harsh letter. And we see people in the markets, whether it's Jeremy Siegel or Jim Paulson. There are a lot of highly regarded people who feel the Fed has overdone it. I think that criticism is going to increase.
Great to catch up, Greg. Just awesome. No doubt we'll speak to you, touch base again before the midterms. Greg Valliere of AGF Investments. Tom, within 2 weeks now, to that vote, to the result of those votes.
We're going to have a lot of coverage of this and do it in a Bloomberg surveillance way, which I think is to fold in the polling and that, like what Valliere lives in, but as he does as well, fold it into the economics forward. The one thing I will say is there's a huge certitude that with gridlock or even Republican ascendancy, tax increases, vapor.
Yeah.
Vapor.
He mentioned China there just briefly. You know, something we haven't talked about because it's a busy day. I get that. The Chancellor of Germany, Scholz, Tom, have you seen this story? The German government has agreed on a compromise which will allow Chinese state-owned shipping conglomerate Costco to buy a 24.9% stake in one of Hamburg's port terminals.
And Americans are clueless on this. There's a huge relationship there.
There's a real tension
What's it called? Belt and suspenders? What's the theory?
I think you mean Belton Road.
Belton Road, that's it. Yeah.
I'm not sure it's called
It's
Belton
not
Suspenders.
Germany. It's it's a different relationship.
Where on earth have you got that from?
I have no idea. I have no idea. Can we talk about
there's
something?
a real concern over
Can we
this.
go sensitive now?
Yes.
You know, Lisa and I, we have a foreigner with us, but I think we're going to bring this up because nobody else in the media is.
How long have I lived
John,
for?
I mean,
John, seriously, I'm going to bring this up now, folks.
Go
and this
ahead.
is delicate. Afterthought is in school right now, and in a religion class, they're studying Hindu. This is momentous in your United Kingdom, this new prime minister.
Sure.
And there's people in America where it's lost in translation the difference of the history of the United Kingdom and religion versus America in that. Explain it, what it means for most of the United Kingdom or all. There's some idiots out there.
There's always
but
some idiots.
Explain what it means.
No, I think it's absolutely fantastic. And I think we've talked a lot about the diversity of the Conservative Party in terms of the makeup of who leads
Unthinkable in America.
the party and the makeup of the Chancellor.
Mr. Cleverly staying as
Chancellor
foreign
Clark,
minister.
whatever you think, that was an historic decision by Liz Truss as well. And Tom, for me, I think the controversy is not going to be around that stuff. I'm happy to say.
Right.
I think the controversy is going to be about a very rich, wealthy individual, a billionaire through marriage, going through with austerity in the United Kingdom and cost of living crisis.
And the process to get here, is that a part of it as well?
Sure.
Okay.
From New York City this morning, good morning. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And So I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
Those numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Investors are obviously skittish as the Fed pulls away the punch bowl of easy money.
I do think the risk is that they end up doing more than what they've already signaled in the dots plot.
They're going to stick with tightening, at least for the Fed.
Yes, other central banks are hiking, but they're also beginning to slow down.
I think we've already done too much, and we've set a chain reaction in motion that is going to lead us to real problems later this winter.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An eventful Thursday, much going on, including in 15 minutes, Christine Lagarde and the ECB will report. And then on to the press conference. John, what will you listen for in the Lagarde press conference?
The tone around the economy, the balance of risks as well, and the conversation, Tom, around the balance sheet. They're willing to hike 75 basis points potentially into a recession. Are they willing to unwind that balance sheet into the financial instability that we've seen through bond markets over the last month?
In the intro, they talk about the punch bowl. I don't believe there's a punch bowl in Frankfurt. I think it's so messed up. It's not anything conventional. What's the difference in Lagarde's balance sheet versus Powell's balance sheet?
Powell doesn't have Italy on his balance sheet. Without a doubt, that is the biggest difference. Without a doubt, Tom. And that's the problem with Europe and the bond buying program. You've got so many different countries, so many different bond markets just sitting there, facing very different situations.
What was the thing that was like 8 months ago, 7 months ago, out of an ECB meeting? They were going to do a plan. They were going to do an individual bond plan where they summed it up and
TPI?
put it in.
You're talking about TPI, the Transmission Protection
Instrument? That's it, the transmission, I forgot
that. Was to contain spreads.
Where are we on the TPI this morning?
TPI hasn't been activated. TPI is meant to work like OMT. Do you remember OMT?
I remember OMT. Klaus Regling was one of my favorites on this.
Draghi came up with OMT, outright monetary transactions.
TPI.
That was that great whatever it takes moment in 2012. OMT was never activated.
OMT.
And OMT was very effective.
The one that was better than any of them was EIEIO. That was so good. I mean, Lisa, this
you
is
can
what
laugh. One of us had to learn all this stuff.
Oh, McDonald, he was American, lived in Kentucky. I mean, Lisa, come on. It's alphabet soup of people making it up as they go.
Trying to offset some of the financial stability concerns as well as some of the just social concerns in a place like the European Union, while also combating inflation. is it an impossible task? And ultimately, how much is inflation going to cooperate? And that, I think, is really the underpinning of the bulls and the bears. The bulls think that you're starting to see, the bulls for the market, not necessarily the economy, think that inflation is starting to roll over a little bit faster than people think. And the bears say this is a structurally higher inflationary regime that you're going to see the bond vigilantes and the currency vigilantes come out in force.
My surveillance correction of the month, John, was ahead of the Dutch central bank leaning over in the middle of the interview and saying, hey, stupid, inflation in the Netherlands is not 11%, it's 17%. But is that 17% old news?
Well, let's talk about the Eurozone at the moment. Double-digit CPI, so 10%. We'll get some inflation data a little bit later this week. Can you say we've seen the peak in Eurozone inflation? I think a lot of people on core, Tom, are not comfortable with that call just yet, and that's the problem the ECB has. This was always going to be the dilemma. It was the classic EM dilemma for these central banks in DM. A dilemma, Tom, they haven't faced for a long, long time. That's upside risk to inflation and downside risk to growth. And they've got a preference here, and that's to attack inflation. And that's the mandate of this ECB.
Lisa, what do bonds say? They're the price, they're the thermometer of the system. I mean, parity on euro, but what do bonds say in Europe, and how do you roll that over to America?
My favorite thing is that bonds are trading like Bitcoin. I mean, not quite like that in Europe, but you have seen bond yields get tempered a bit. And I wonder how much the Bank of Canada decision yesterday, where they came in with a smaller rate hike, how much that's going to end up setting the tone for central banks around the world, that they can step down, Tom.
Let's get to the data right now and step down to a red and green on the screen. John, I'm going to go the more industrial, the bigger, the uglier names like the Dow Jones Industrial Average have a lift the last number of days versus a NASDAQ flat on its back.
Flat on its back because the likes of Alphabet was down 9% and Microsoft was down 7 or 8, and Meta this morning, you want to know where Facebook is? Facebook's down almost 23%.
Which is worse than 2 hours ago. The trend's in the wrong direction.
And it's getting worse right now. Euro dollar is negative 0.4%. Dollar making a little bit of a comeback, some dollar strength going into the ECB. That decision 11 minutes away, and yields are higher on a 10-year in America, Tom, up by 7 basis points to 4.07%.
Stay with us on Credit Suisse through the morning as well. A reorganization at the beleaguered Swiss bank. Right now, Jeremy Stretch joins to get you out 12 minutes to the ECB decision ahead of G10FX at CIBC. Jeremy, what will you watch for in 10 minutes?
Well, you're absolutely right. You've just been previewing it, and I've just been listening to your comments. Well, clearly, it's very much about the decision itself in terms of that assumption that 75 basis points is baked in. Even the Doves have seemingly acquiesced that view, but of course, there is still a small residual risk that the ECB doesn't follow through, but it seems most likely. But more so, it will be very much that language regarding the forward-looking bias towards the growth trajectory, any adjustments in terms of the balance sheet, and also in terms of the TLTRO position, in terms of the potential arbitrage between the higher deposit rate and those TLTRO rates, and whether that is going to see a graduated degree of liquidity reduction in the Eurozone, which I think could well be quite instructive for Euro valuations going forward.
So, Jeremy, 3 issues, the rate hike, the balance sheet, and TLTROs. Let's talk about the balance sheet just a little bit more on the prospect of QT. They're willing to hike into recession risk. Do you think they're willing to do QT into financial instability that we've experienced in the last month or so?
I think they're starting to debate or at least discuss QT, but I think we're still some way away from actually getting towards any degree of even passive QT as far as the ECB is concerned. So if we are, and when we see this process starting to be underway, then it will be most likely be that passive nature, so no longer reinvesting all of the maturing proceeds. But I think that's still very much a story for well into 2023. I think the ECB and the bank would be much happier to, at the very least, get rates back towards some degree of neutrality before they start to consider the balance sheet adjustment. And that neutrality in terms of the ECB is probably somewhere in the region of 2 to 2.25%. So even if we do 75 basis points today, we have some way to go. So I think QT is probably still a story for 2023 rather than 2022.
Jeremy, we've been looking at bond yields in the German region, throughout the Euro region. They had been coming down just a bit before today, and they are pairing some of the gains on price and a rise in yield. How much have we baked in the idea of a slowdown in the pace of rates? It's material after a 75 basis point rate hike in about 10 minutes, 9 minutes time.
Yes, I think that's very much what the market is predicated upon, that if we are going to see 75 basis points today, to follow on from the previous move of that magnitude, the market is very much anticipating that the ECB will be not quite so aggressive in terms of its policy perspective going forward. So we at CIBC would expect 50 basis point move in December, and then ultimately probably a 25 basis point move most likely into the beginning of 2023. But at that time, I think we are getting to a scenario where the rolling over of inflation will prove to be a little more substantive, a little more durable, and at the same time we see those headwinds in terms of the macro backdrop playing out, and I think that will have an impact in terms of the ECB's reaction function, such that I think they will struggle to meet what is currently priced into the OIS curve for 2023.
If the ECB pulls back a little bit and signals that they're open to just a 25 basis point rate hike in December, is that bullish or bearish for the euro?
Well, that's a very good question, because clearly markets, as I say, are priced in a reasonably aggressive scenario. Now, normally Economics 101 would argue that a lower rate hike would be detrimental to a currency, but I think in a backdrop where you are seeing macroeconomic headwinds, and we have already seen some fairly substantive policy tightening from the ECB, I think actually rather unusually, it may well prove to be a little more supportive. So providing a little more of a tailwind to growth, and perhaps also reducing or precluding some of those fragmentation risks from becoming even more amplified as we run into year end.
Jeremy, it's the last decade in reverse. In the last decade, we had a cohort of Germans complaining about the easing of the ECB, and now you hear from the Italian Prime Minister complaining about the tightening of the ECB. Jeremy, the politicization of this European Central Bank, is that something they can handle as an institution? Are they resilient? Does it damage the signalling that comes from the ECB? What do you make of it all?
You're absolutely right. I think in a sense that does underline the difficulties that the European monetary system has relative to the Fed, and that was I noted when you were talking before you came to me regarding the difference between the balance sheet of the ECB and the Fed. Well, clearly that politicization and the differential positions and the political backdrops across the Eurozone do make the job of the ECB incredibly difficult, and of course you then throw into those fragmentation risks. So we are seeing increasing degrees, and probably will see increasing degrees of criticism on both sides of the equation in terms of the policy backdrop from the ECB, whether it's too aggressive a tightening in the context of, say, someone like Italy, and perhaps some of those Northern Europeans and Nordic countries where inflation has been very elevated for a protracted period of time, arguing that the ECB is still being rather too lax in its policy. And that really underlines the difficulties that the ECB has, and that's probably why having somebody who has a very strong political background at the top of the ECB is perhaps quite useful beyond any uncertainties that you have that Lagarde is not a trained economist.
Hey, Jeremy, thank you. We're going to build on that in a moment. Jeremy Stretch there of CIBC is going to stick with us into the ECB decision. Everyone seemingly wants a weaker currency, or rather they want the US to have a weaker currency specifically. They want a weaker dollar. MasterCard sees the fourth quarter adjusted growth impact, Tom, 6 to 7% by FX. We have seen a lot of that over the last couple of weeks.
Some volatility there, and stock trades off. It's down, I believe, 4% here. Not all that much given the last number of days surge, but you know, the new 3 to 4% is 6 to 7% by foreign exchange. And to everybody's conversation here, when's the win of dollar weakness? Everybody's gotten old and gray waiting for dollar weakness. It's not happening.
Waiting for it at the ECB as well to fold it into that conversation. Elisa, President Lagarde, I'm sure would love to see a weaker dollar.
Yeah, but at what point does this start to actually feed into U.S. economic growth? Because we're seeing these companies see margins crimped as a result of some of the FX headwinds. At what point does it become the U.S. problem where they're incentivized to actually do something about it? I don't know. I mean, people are saying not yet. You're still seeing earnings continue to perform.
Can I just say 99 handle on Facebook, Tom?
Wow.
99.
Wow, just dropping.
Do you know where that was in the middle of 2021?
Where's the board? Where's the board?
387.
It's nuts.
It's a private company masquerading as a public company. Is that too harsh?
I think you could say a lot harsher than that.
That's aimed at Zuckerberg. Stock's down 23.5%. Brutal. ECB rate decision coming up from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In just a few minutes, the European Central Bank is likely to lift its main interest rate to the highest in more than a decade. It's trying to lower record high inflation. Almost all economists surveyed by Bloomberg predict a second straight 75 basis point hike today. President Xi Jinping says China is willing to work with the U.S. to find ways to get along. The comments came before a possible meeting with President Biden next month at a Group of 20 summit. It signals an effort on Xi's part to maintain ties despite disputes over everything from Taiwan to chips to the invasion of Ukraine. Credit Suisse is planning a sweeping overhaul. It includes a $4.1 billion capital raise, a carve-out of its investment bank, and thousands of job cuts. It's the most urgent attempt yet to repair Credit Suisse after huge losses and management chaos. In breaking up the investment bank, the firm will create a separate advisory and capital markets business that will revive the First Boston branding. In Singapore, the head of the central bank says Southeast Asia has done a decent job of allowing markets to absorb some of the shocks from the surging U.S. dollar. Ravi Menon spoke with Bloomberg.
A whole lot of things can happen when the exchange rate moves too fast, too far. But I think so far they've been managing it well.
Indonesia, Thailand, the Philippines, and Malaysia are all struggling with more than 8% depreciation in their currencies this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If you compare the development of the euro towards the US dollar, you see a certain decline, and therefore, that might also, in the end, of course, make imports more expensive and import inflation. So I think the ECB has all these things in mind. It acts pretty much in line with what other central banks are currently doing.
The German Deputy Finance Minister seems to be happy with the ECB, which is a change from the last 10 years, because this time the ECB is hiking interest rates, it's not cutting, and it's going to cease end bond buying and maybe execute QT. That decision's about 50 seconds away, Tom, and going into it, we have a weaker euro-dollar, still just above parity, euro-dollar on the session, down 0.5%.
That was clearly the tone I had in Washington with Axel Weber, is the vector here of ECB is calming to the Netherlands and to Germany.
They're happier with this trajectory, Tom.
They begin the morning happier.
Well, Lisa, I said it was the last 10 years in reverse, because it was the Germans complaining about policy being too loose, and now you've got the Italians who predictably, with a new prime minister, are going to complain about things becoming too tight too quickly.
Yeah, well, they also have a different leg right now, because Germany has been on the front foot of, I don't want to say the offending camp here, but part of the issue in terms of what's been going on and the dependence on Russian oil and all of that. So how much is there a bit of, hey, we need to throw you a bone in order to stay part of the union, which is the reason why there might be more willingness by the ECB to close spreads and to try to help some of the borrowing costs.
You're being far too kind. That is the weak link in the economy right now, without a doubt. That decision has just dropped. 75 basis points was the previous number. We got 150 on the depot rate, so we go from 75 to 150 on the depot rate, in line with expectations. On the marginal lending facility, from 150 to 225. On the main refinancing rate, from 125 to 2%. So all slap bang in line with what we expected. Going into it, you had a weaker euro-dollar down about 0.5%. That's where it stays right now. Starts to roll over just a little bit more. I'll get into the additional headlines in just a moment. Yields in Italy were higher on a 10-year. They stay higher, up by about 10 or 11 basis points on a 10-year to 441. As you'd expect, Lisa, the ECB expects to raise interest rates further from here.
You know, it's interesting to see that euro weakness just sort of accelerates throughout the session after these headlines. I'm watching right now, 1.0013% per dollar. How much can we get this sort of sense that the outlook is deteriorating? And that's sort of what I'm looking for in some of the comments that we hear, with inflation staying above the target for an extended period of time, seeming to suggest ongoing hikes going forward.
Just pulling up the statement quickly, Tom, for anyone following the asset purchase program at the ECB, PEP and all those other acronyms. Here's the quote for you. The Governing Council, you're laughing. The Governing Council intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it started raising the key ECB interest rates, and in any case for as long as necessary to maintain ample liquidity conditions and an appropriate monetary policy stance. As concerns the PEPP, PEP, Tom, Pandemic Emergency Purchase Program. Let me complete it. I'll get through it. The Governing Council intends to reinvest the principal payments from maturing securities purchased under the program until at least the end of 24. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. The Governing Council, Tom, will continue applying flexibility in reinvesting redemptions coming due in the PEP portfolio with a view to countering risk to the monetary policy transmission mechanism related to the pandemic. Was that enough monetary policy speak, Tom, in a couple of paragraphs?
And only you can do it, John. I could never do that. It was very, very impressive.
Listening.
What I would suggest here, John...
Is anyone out there?
No one's out there right now.
Yeah, exactly. On Bloomberg Radio, 47 people turned their radio off on I-80. What I would suggest here is two things. One, how different these headlines are as a set from what we see at 2 p.m. for the United States Central Bank. But the other thing missing here is the Draghi confidence of a timeline out 1 year. I don't see 2023,
Who's confident about
2024
anything right now, Tom?
The Draghi timeline headlines have disappeared.
So we got the 75 from the ECB. I gave you the balance sheet unwind talk.
You nailed it.
Am I allowed to do the Taltro stuff, or would you like me to avoid it? Shall I avoid the Taltro stuff? I'm going to bring you the Taltro stuff, okay? The Governing Council decided to change the terms and conditions of the third series of targeted long-term refinancing operations. During the acute phase of the pandemic, this instrument played a key role in countering downside risk to price stability. Today, in view of the unexpected and extraordinary rise in inflation, it needs to be recalibrated to ensure that it is consistent with the broader monetary policy normalization process and to reinforce the transmission of policy rates increases to bank lending conditions. Leads to the final word here. The Governing Council therefore decided to adjust the interest rates applicable to Taltro 3 from the 23rd of November 22 to offer banks additional voluntary early repayment. rates.
So hold on a second. It's like English words that are not English, right, put together?
Well, none of it is.
But, so that's what central bank speak maybe is. To translate, how much are some of these cheap loans? I was actually just reading up on this because I didn't really understand it. How much are these cheap loans sort of a problem for an ECB that wants to tighten conditions for banks? So they're saying you can pay them down now, get them off your books, or we're going to raise rates on you. Is that right?
I'm not sure the banks are going to be happy with this. But that's the smallest of violins.
As we have with all this alphavet soup, we've got someone who speaks 14 languages.
Maria Tadeo.
Maria's
going to translate this right now in Frankfurt. Maria, I did that for you, so
you saved her the agony.
You can be a lot more direct about what's just happened at the ECB, Maria. What are we looking for in that news conference in 20 minutes' time?
Well, look, clearly two things. The 75 basis points, that was very well guided for the market, very well calibrated. The key here would be the signal going into December. 75, there's nothing that is new about that. The market was expecting this, and of course, for those that wanted to see real action against inflation, they'll be satisfied with this. And of course, I'm thinking of the German central bank. The other real takeaway, which to me is the key here, is the changes to the TLTRO program. There's two reasons why this is happening. First of all, the European Central Bank wants to drain some of the excess liquidity on this. Remember, European banks sit on 2 trillion euros of this, and they're changing the conditions for it. We need to wait and see the technicalities around it, but they are changing the terms. These for the banks, well, they may not be happy, and this could potentially entail some litigation. The question is whether they want to take on the central bank or not, but those are the two big things. Change in TLTROs and 75 basis points confirmed.
Maria, Attorney Lagarde is not economist Draghi. Explain the inner politics that are behind her at her press conference here in 25 minutes. What does Christine Lagarde need to juggle here within your European continent?
Listen, she's not an economist by training, and that's always been the criticism, that she is not technically perhaps as Mario Draghi was. Remember, this was the idea that Mario Draghi was the maestro of markets, that he could really talk markets into doing anything that he wanted. But the reality is, at this point, and you alluded to this in your previous conversation, this is a central bank that has to cater to tensions that are different, to countries that are in different positions. Of course, when you look at Germany, when you look at Italy, these are sitting on two opposite sides of the spectrum. What I hear repeatedly in Frankfurt is she may not be a trained economist. She may not be technically as good as Mario Draghi is. But at this point, you need someone that has a political instinct to get to consensus, appease everyone, and calm things down. At one point, and this is very well reported, Mario Draghi was someone who was perceived by some members of the European Central Bank as too aggressive and taking decisions by himself. The fact that she's seen as a consensus maker at this point, where this is in many ways new territory for the European Central Bank, some tell me in Frankfurt is actually the best way to go about it.
Hey, Maria, we'll catch up later. Fantastic coverage, as always. I have to say, Tom, reading through the statement, not really even a whisper of QT in this, and the Italian move fades a little bit off the back of that.
Jeremy Stretch continues with us with CIBC. Jeremy, what will you listen for from Lagarde? She's going to come out. She's going to make a formal written statement. And folks, I'll be blunt. The questioning at the ECB, I think, is sharp as attacks from the journalists there. Jeremy, what's the question you're going to listen for that she needs to answer?
Well, I think the market is very keen to understand where the terminal rate is and to see whether the ECB is moving away from this whole front-loading narrative and is still just on a market meeting process, I should say, and really is going to be driven by the data. So I think we need to see, and I'm trying to understand how the terminal rate plays out, and see then if that reflects back into how that will play into QT, because as you say, from the reading of the language, from what I've heard thus far, there seems to be no change in terms of the ECB's language, in terms of its balance sheet adjustment. So I think markets will be very keen to try and understand what that process and what the procedure will be in order to encourage the ECB to consider rowing back its balance sheet through 2023.
Jeremy, I'm curious your view on how Christine Lagarde should approach the very increasingly political question of raising rates into a downturn. How much does she have to acknowledge the downturn in order to provide some conviction to markets that they really are going to hike as much as they're saying?
I think the ECB does have to remind itself and remind markets, I should say, that its primary ethos is to control inflation. And if we think back to the creation of the ECB all the way back in the late 1990s, it came out of the Bundesbank. And of course, as we know, the Bundesbank was driven by that fear and determination to hold down inflation. So I think the ECB needs to remind the market that that's really its primary focus. Yes, it has to do some and make some fairly painful and unpalatable decisions when we are undergoing a slowdown. But I think also the bank will need to be mindful of the fact that some of those inflationary pressures are starting to diminish, but they need to remind the market that primacy of inflation is the preeminent factor. And if they can bear down on inflation, that will provide a more constructive backdrop for the latter stages of 2023 and into 2024.
Jeremy, wonderful to hear from you, sir. Thanks for being with us through the first 25 minutes of this hour. Jeremy Stretch of CIBC, euro-dollar session lows, negative 0.75%, just about holding on to parity. Haven't seen a 99 handle just yet this morning, but getting very close to it. Italian yields fade. They were higher. Now they're lower on an Italian 10-year by a couple of basis points. For everything in that statement, they said so much without saying much at all. And for that reason, there's not even a whisper of QT in this on my first and second read, Tom. And I think that's why the Italian yield story is backing away. Well, so an incredibly vague statement on two big issues, Tom, QT and the future of interest rates.
I'm doing math on Italy, and I did a very fancy study only on the Bloomberg you can do, and it takes me back to 2014. So I believe I'm back 8 years on Italian-German spreads, and we're out well over one standard deviation. What are the consequences, John, if the Italian-German spread widens for Christine Lagarde?
They were clearly uncomfortable with 250. I wouldn't say they're comfortable with 220, but it's a relative game, Lisa. 220 is obviously better than 250, and based on this morning, things are heading in the right direction. But they're heading in the right direction this morning because they're not talking about QT. So let's wait for the news conference, because someone's going to ask about it, aren't they, in the next 60 minutes?
How much do we get any new information whatsoever from this particular statement? It was bang in line, as you said, with expectations. They didn't mention QT, and we're just basically scraping at the edges to have anything in order to make some sort of move. I still am not totally understanding the euro move and why the euro is weakening on this. I don't know. Is that QT?
Did you understand that statement at all?
It was beautiful.
That's what central banking has
become. It was clear, John, after you explained it to me.
That's what central banking has become, and that's the problem. From New York, this is Bloomberg.
difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Data in America about 8 seconds away. Mike McKee runs into the studio to get prepared for this. Equity futures on the S&P 500 just about positive, up by 0.05%. Yields are higher by 5 basis points. In the US, the data drops. Mike McKee, what have you got?
Well, let's start with initial jobless claims, since that's the least important thing today. 217,000. That compares with 214,000 the prior week. It's lower than anticipated. So jobless claims are telling us that the labor market is still in good shape. Now, GDP, third quarter gross domestic product for the first release, 2.6%. which neatly splits the difference between the Atlanta Fed's 3.1% GDP now and the Bloomberg consensus of 2.4%. Remember, the first 2 quarters of the year, we saw contraction. It doesn't. I've not seen yet whether any of that has been revised. Personal consumption, waiting on that number here. I'll have to look into this. Personal income, personal consumption. We'll look for it in just a second. But the GDP price index, which is not really widely followed because it's a quarterly number, is 4.1%. Durable goods orders up 0.4, not quite as good as expected. 0.6% was the consensus. Ex-transportation down 0.5, and capital goods orders, non-defense ex-air, down 0.7. Now that tells you that maybe businesses are starting to pull back because of the higher cost of investment, and shipments were down 0.5%. So it does suggest also that business spending is a little bit weaker than the markets may have hoped for, given the Fed and what they have been doing.
Mike, you can run us through the details in a moment. I'll run through the markets. So the move in the bond market this morning was yields up. It fades. Bear in mind there's a big rally in the Bund market in Germany off the back of this ECB decision, so that factors into this move as well. The 10-year yield on a treasury at the moment up about a basis point. Was up 4 or 5 just moments ago. Equity futures a leg higher off the back of this, now positive 0.5%, and the dollar even stronger, Tom. Euro dollar negative 0.7%. Briefly, just briefly off the back of the ECB, we did get a 99 handle on euro dollar, Tom. Just a brief break of parity this morning.
Help me with a date calendar here. November 2nd is a Fed meeting, and inflation is is
November
after that
10th.
Fed meeting.
November 10th.
Do they get a view, Mike McKee, at the Fed of what inflation's going to be 8, 9, 10 days before the report?
No, but we do get the PCE number, which is the Fed's favorite and preferred indicator. We get that tomorrow.
We get that tomorrow.
So, for the month of September. So that's the.
Is the market getting out in front of that, of a disinflationary trend?
I don't think so, not yet. They're going to. We've got 75 priced in, and you do have still the idea of a rate cut next year. But this Fed, and you were talking about it just before the ECB decision. This Fed is going to be meeting to meeting for a while as they see the data come in. Let's take a look at some of the numbers in the GDP, and here's the one that really jumps out: residential. The Fed has clamped down, mortgage rates have shot up, and residential is down by 26.4% over the second quarter. The residential contribution.
Do you have a GDP percentage of that? Is that easy for you to garner?
Residential is just over 1% as part of the overall GDP.
Can you explain what that means in terms of subtracting 26.1%?
Well, it's not subtracting. It's 26% lower than it was.
The year. Okay, so this means that basically the momentum is contributing to this. How much, when you dig into the features of the GDP report, does it highlight this weakness that people were talking about below the surface, even if you get a rebound in the average or, just sort of year-over-year comp?
Just looking through that now, we got weakness in business spending. Non-residential fixed is up by, it looks like, up by 3.7%. That's a little bit better than it was, but when you break that down and you take structures fell by 15.3% out of that. Equipment's up 10.8%. So business investment hung in there, but wasn't great. And the personal consumption number, 1.4%, is down from 2% in the second quarter, up slightly from 1.3% in the first quarter. Consumers are spending, but they're not spending a whole lot. Now, the other things we want to look for are government spending. Government spending still fairly strong. I'm a little surprised, state and local, 1.7. They're the ones who have the money at this point. The federal government's been cutting back, but a lot of this spending is on national defense, 4.7%. So, they are replacing all that stuff they are sending over to Ukraine.
Mike, would you like to translate this corporate headline from the McDonald's CEO? Sees a mild to moderate recession in the United States. What is a mild to moderate recession in the United States?
There's a lot of questions about how you define that, because some Fed officials have suggested something along those lines, and it seems to be what they're talking about is a small contraction in GDP, but a not very big rise in unemployment. If the Fed got to 4.4%, which they had forecast, you might be saying, well, okay, that's a mild recession. But a lot of people say they're going to have to go higher than that. Quickly looking at the other aspects of this, which always fall into the question of how did this work out. Exports were up by 14.4% and imports down by 6.9%. So trade contributing significantly to the overall package here. Inventories up by 61.9 billion. They were up by 110 billion in the second quarter. So inventories are subtracting from growth, and exports are adding to growth at this point, net exports. So it is, as Lisa said, an under-the-hood kind of story for the Fed. I said this morning on early surveillance that this is kind of a non-informational for the Fed. It tells them some things about the composition of the economy, but doesn't change their view of what they need to do.
Is there a show before this one?
There's early surveillance, and then there's early surveillance.
There's an early one.
Early surveillance.
What time did they wake up for that?
Manus Cranny's doing it or
That is brutal. What time did they wake up
for that? It's a
Manus
Manus Cranny production.
They're just getting up now.
And you get up for that too. That is out of order. I only woke up 20 minutes ago when
Oh,
the
all
ECB
right.
came out, and then I sent everyone back to sleep.
Yeah, I know. I
reading the
slept in at
statement.
5:55 for late surveillance as well. Michael McKee, thank you so much, and he'll dive into all that data for you. First look, third quarter GDP. There is a single sentence from Hollenhorst and from Nathan Sheets, global chief economist at Citigroup, also is public service to the United States Treasury, and Nathan Sheets joins us right now. Nathan, there's that single line of global GDP in 2023. It is well below the typical 3% level. How bad is the global recession of next year?
The global economy, as you say, Tom, is looking very soft at the moment. In aggregate, our projection is 2% global growth. If you take out our relatively bullish expectation for China, we see global growth at less than 1% next year, which is right on the border of what's been traditionally associated with a global recession. Now, looking a little bit more at the details, we see early next year fairly severe downturn in Europe, including both the euro area and the UK. And then as the year progresses, the monetary tightening in the United States leads to a recession during the second half of the year here as well. So pretty tough outlook, challenging in a lot of different respects. And that's coupled with an inflation outlook that remains very concerning.
Nathan, financial conditions have eased. With the backdrop you're talking about, financial conditions have started to ease. And that's because a lot of people are thinking about the Federal Reserve backing away from the pace of hikes, go from 75 maybe down to 50, the size down to 25. Nathan, what do you make of that conversation?
I think the Fed has struggled in its communication. It has set up, at least implicitly, a syllogism that if we're serious about inflation, then we go 75 basis points. And when rates are low, it makes sense to have that syllogism. But once you move to 3%, and in November there'll be at 3.75, as you move higher, you've got to start casting your determination and framing your determination to fight inflation in different ways. Specifically, the Fed can say we move substantially, and that reflects our commitment. And if you don't believe that we're committed, just watch what we're going to do. So I do think they're in a tough situation where they've got to pivot. They can't take rates up at 75 basis points rate indefinitely. And the markets are interpreting that as the Fed kind of pivoting off inflation determination, which I think is a misinterpretation of where they are.
I'm looking right now at some of the GDP components. Michael McKee was breaking them down, and we saw housing. He mentioned housing, and he just clarified that residential investment subtracted 1.37% from GDP. This is a quickly moving story. Under the hood, how much are other inflationary components offsetting some of these disinflationary moves that we're seeing in the housing market, that we're seeing in retail, that we're seeing in used car prices, that you could see on the margins around the economy?
Very clearly, we are now in a dynamic of disinflation in terms of goods prices. That is clearly happening. We expect that it's going to come off quite sharply in coming months. Similarly, the shelter prices are persistent the way they're calculated in the indexes. But when we're getting these monster declines in residential investment, that's pointing to a very soft housing market. But where the heart of inflationary pressures remains is in the non-sheltered services. And that is tied to the hot labor market, rising wages, and rising services inflation. That is what the Fed's worried about. And that's what the Fed is targeting here effectively, is they've got to see more contained numbers in terms of non-shelter services price inflation. And that may yet take a while.
I look, Nathan, at how we're going to recalibrate. We're going to recalibrate off this press conference. John, what, in 4 minutes?
Something like that.
We're going to recalibrate November 2nd. Frame the Citigroup look for next year. I'm going back to your stunning global GDP call of 2% next year. What is your year opening report going to look like? Give us a heads up.
So what we're seeing at the moment, and it's looking pretty durable in my mind, we're calling next year rolling recessions in the global economy. We're going to see various countries turn down. The vast majority of GDP will see a downturn. That would particularly be accentuated and exacerbated if the Chinese economy ends up being somewhat softer, and instead of the 5.5% we're forecasting, if it's more like this year at 3.5%. And so you've got this on the growth side, and then you also have central banks that are going to have to, early in the year, continue to hike. And as the year rolls on, our expectation is hold those rates at high levels. So next year is going to be a challenging year. I'm kind of already turning the page to 2024.
There you go.
Skipping
Put it
23
down.
already.
Skip
Yeah.
20.
Yeah,
that sounds so
exactly.
much like that's what we need from a former government official.
Yeah.
Dr. Sheets, that was brilliant.
Nathan Sheets City. Nathan, thank you. In the next month, as you all know at home, we're going to get the annual outlooks, Tom, from so many of these banks. And I wonder if they take the Nathan Sheets view and just say, yeah, in 2024, this is what we think.
And rule number one here is the Pharaoh rule, folks, is the annual outlook really starts
in
March 31 or so, which I think is actually pretty smart. John, I just got to say this. If you take me back to 2006, if you take me and Mike McKee back to 2006, it is unthinkable that we would frame sub 3% global GDP, that with a buoyant China. It was literally not in the framework that we thought about, right?
No, you can't.
It was unthinkable.
It's not even an outlier view anymore, Mike. It's not even an outlier view. A two-handle on global GDP kind of sounds like the view right now.
Global recession is basically what you're going to get. We know Europe's probably already there. The Swedes today basically said that their confidence numbers were so weak that essentially tells them they're going to be in recession. So you're looking at recession in Europe, you're looking at probable recession in the United States, and for all intents and purposes, China's growth rate is, for them, a recession.
We're getting that commentary from the CEOs right now. Comcast, which owns Sky in the UK, of course. The Comcast CEO moments ago sees pressure on Sky from a weaker European economy. I talked about McDonald's coming out with a series of headlines. The CEO has made a few comments this morning. Bear in mind that EPS was a beat, revenue was a beat, sales were a beat, but this is what he has to say on the economy. Sees a mild to moderate recession here in the United States. He goes on to say, listen to this, Tom, more significant recession in Europe. Franchisees are under financial pressure in Europe. Even talks about China, still a challenging environment in China, sees increasing uncertainty, unease in the economy.
Our financial conditions index, Goldman Sachs has a great index as well. There's others as well, but it's made up of like 8, 9, 10 soups of ratios by really smart people, not me, figuring this out. The European financial conditions index, John, is by itself. Maybe it's war, but the fact is, it is unique and discrete compared to other nations.
Euro dollar right now, negatively. So going into this news conference with President Lagarde, we're down about 0.6% on the euro.
If you can make sense of the moves and the pretty aggressive moves right after this particular news release, please let us know. But I personally can't really translate the why behind it other than perhaps some, overthinking deep analysis.
You're going to make this my problem.
100%.
I'm going to make it someone
You're the
else's
foreigner,
problem.
as you say.
President Lagarde's just
I'm
walking into the
kidding.
room in Frankfurt, Germany, and it's going to be President Lagarde's problem in just a moment, Tom. The usual photos taking place. This one, I think they tried to make boring, Tom. I think in Europe, it's going to be anything but boring for a long, long time.
And she's going to be reading off of a lot of prepared statements like Chairman Powell. I don't know if Mr. Kuroda does that in Japan, but she's going to get some questions where she's just going to simply go to the statement to read the formal answer.
She'll be asked about? The step down. The step down. Potentially a step down from 75.
Maybe she'll do it more elegantly in French.
Fed-style
I don't
questions.
know how you
What is
translate
step down in French?
Le down du steep.
Is that right?
Oh, that's dreadful.
That was
you.
beautiful.
Is that dreadful? Nailed that.
Bramo, I'm sure you've got much more important questions than the step down when it comes to Europe.
But
and
I
the
love it.
CCP.
What I really want to hear from her is the outlook for some sort of downturn and that political pressure to keep hiking, even as you do see that downturn accelerate, to me is one of the key questions.
The European Central Bank President, Christine Lagarde, very much in focus after hiking rates 75 basis points, doubling interest rates on the depot rate, doubling them in one single decision from 75 to 150. And Tom, we do it on a week where we've had PMIs in Europe in the 40s. And I never thought I'd sit here and say this, PMIs in the 40s and an ECB rate hike of 75 basis points because CPI is basically at double digits, Tom. That's the problem.
It's so complex.
Vice President Stigindos.
Let's take a listen to the ECB President Christine Lagarde as that news conference gets underway in Frankfurt, Germany, off the back of a 75 basis point interest rate hike. A lot of words used in the statement. They didn't say that much, though. There's been a change to the TLTRO. I'm sure there'll be questions about that. But there wasn't much on QT at a balance sheet unwind, and I imagine there's going to be tons of questions about that. So President Lagarde in just a moment. Christine Lagarde starts that conference right now.
The Vice President and myself are delighted to welcome you to our press conference. The Governing Council decided today to raise the 3 key ECB interest rates by 75 basis points. With this third major policy rate increase in a row, we have made substantial progress in withdrawing monetary policy accommodation. We took today's decision and expect to raise interest rates further to ensure the timely return of inflation to our 2% medium-term inflation target following our meeting-by-meeting approach. Inflation remains far too high and will stay above our target for an extended period. In September, euro area inflation reached 9.9%. In recent months, soaring energy and food prices, supply bottlenecks, and the post-pandemic recovery in demand have led to a broadening of price pressures and an increase in inflation. Our monetary policy is aimed at reducing support for demand and guarding against the risk of a persistent upward shift in inflation expectations. The Governing Council also decided to change the terms and conditions of the third series of targeted long-term refinancing operations known as TLTRO III. During the acute period of the pandemic, this instrument played a key role in countering downside risks to price stability. Today, in view of the unexpected and extraordinary rise in inflation, it needs to be recalibrated to ensure that it is consistent with the broader monetary policy normalization process and to reinforce the transmission of our policy rate increases to bank lending conditions. We therefore decided to adjust the interest rates applicable to TLTRO III from November 23, 2022, and to offer banks additional voluntary early repayment dates. Finally, in order to align the remuneration of minimum reserves held by credit institutions with the Eurosystem more closely with market conditions, we decided to set the remuneration of minimum reserve at the ECB deposit facility rate. The decision that we took today are set out in a press release that is available on our website. The details of the changes to the TLTRO III terms and conditions are described in a separate press release to be published at 3:45 Continental European Time. Another technical press release detailing the change to the remuneration of minimum reserves will also be published at the same time. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Economic activity in the euro area is likely to have slowed significantly in the third quarter of the year, and we expect a further weakening in the remainder of this year and the beginning of next year. By reducing people's real income and pushing up costs for firms, high inflation continues to dampen spending and production. Severe disruptions in the supply of gas have worsened the situation further, and both consumer and business confidence have fallen rapidly, which is also weighing on the economy. Demand for services is slowing after a strong performance in previous quarters when those sectors most affected by the pandemic-related restrictions reopened, and survey-based indicators for new orders in the manufacturing sector are falling. Moreover, global economic activity is growing more slowly in a context of persistent geopolitical uncertainty, especially owing to Russia's unjustified war against Ukraine and tighter financing conditions. Worsening terms of trade, as the prices paid for imports rise faster than those received for exports, are weighing on incomes in the euro area. The labor market continued to perform well in the third quarter, and the unemployment rate remained at the historically low level of 6.6% in August. While short-term indicators suggest that jobs were still being created in the third quarter, the weakening of the economy could lead to a somewhat higher unemployment in the future. To limit the risk of fueling inflation, fiscal support measures to shield the economy from the impact of high energy prices should be temporary and targeted at the most vulnerable. Policymakers should provide incentives to lower energy consumption and bolster energy supply. At the same time, governments should pursue fiscal policies that show they are committed to gradually bringing down high public debt ratios. Structural policies should be designed to increase the euro area's growth potential and supply capacity and to boost its resilience, thereby contributing to a reduction in medium-term price pressures. The swift implementation of the investment and structural reform plans under the Next Generation EU programme will make an important contribution to these objectives. Inflation rose to 9.9% in September, reflecting further increases in all components. Energy price inflation at 40.7% remained the main driver of overall inflation, with an increasing contribution from gas and electricity prices. Food price inflation also rose further to 11.8%, as high input costs made food production more expensive. Supply bottlenecks are gradually easing, though their lagged impact is still contributing to inflation. The impact of pent-up demand, while weakening, is still driving up prices in the services sector. The depreciation of the euro has added to the buildup of inflationary pressures. Price pressures are evident in more and more sectors, in part owing to the impact of high energy costs feeding through to the whole economy. Measures of underlying inflation have thus remained at elevated levels. Among those measures, inflation excluding energy and food rose further to 4.8% in September. Strong labor markets are likely to support higher wages, as is some catch-up in wages to compensate for higher inflation. Incoming wage data and recent wage agreements indicate that the growth of wages may be picking up. Most measures of longer-term inflation expectations currently stand at around 2%, although further above-market revisions to some indicators warrant continued monitoring. The incoming data confirm that risks to the economic growth outlook are clearly on the downside, especially in the near term. A long-lasting war in Ukraine remains a significant risk. Confidence could deteriorate further, and supply-side constraints could worsen again. Energy and food costs could also remain persistently higher than expected. A weakening world economy could be an additional drag on growth in the euro area. The risks to the inflation outlook are primarily on the upside. The major risk in the short term is a further rise in retail energy prices. Over the medium term, inflation may turn out to be higher than expected if there are increases in the prices of energy and food commodities and a stronger pass-through to consumer prices, a persistent worsening of the production capacity of the euro area economy, a persistent rise in inflation expectations above our target, or higher than anticipated wage rises. By contrast, a decline in energy costs and a further weakening of demand would lower price pressures. Bank funding costs are increasing in response to the rise in market interest rates. Borrowing has also become more expensive for firms and households. Bank lending to firms remains robust as they need to finance high production costs and build up inventories. At the same time, demand for loans to finance investment has continued to decline. Lending to households is moderating as credit standards have tightened and demand for loans has decreased in a context of rising interest rates and low consumer confidence. Our most recent bank lending survey reports that credit standards tightened for all loan categories in the third quarter of the year, as banks are becoming more concerned about the deteriorating outlook for the economy and the risks faced by their customer in the current environment. Banks expect to continue tightening their credit standards in the fourth quarter. So summing up, today we have raised the 3 key ECB interest rates by 75 basis points and expect to raise interest rates further to ensure the timely return of inflation to our medium-term target. With this third major policy rate increase in a row, we have made substantial progress in withdrawing monetary policy accommodation. The changes to the terms and conditions of our targeted longer-term refinancing operations will also contribute to the ongoing policy normalization process. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term inflation targets. And we now stand ready to take your questions.
Thank you, President Lagarde. And the first question goes to Caroline Look of Bloomberg News. Caroline, please.
Hi, good afternoon, President Lagarde.
Good afternoon.
Could you tell us whether you are comfortable with the expectation that interest rate steps are going to slow after today's decision and peak somewhere around 3% next year? And secondly, since we're now at the lower end of the neutral rate estimates, would it be fair to assume that the ECB could be ready to lay out a plan for reducing its balance sheet at its next meeting in December?
So that's a bag of questions that you put into one question. So what we have done with the decision taken today is making yet more progress in withdrawing the accommodative and support to demand that was made available. So we have made substantial progress in withdrawing that. Have we completed the job? Have we finished the normalization of our monetary policy, as we have called it? No. There is still ground to cover. What we have reiterated now is that we're going to decide the future path and pace of our rate increases on the basis of the data that we have, and we will do so meeting by meeting. So we are very much and deliberately turning our back to forward guidance, which is not helpful in the current circumstances given the level of uncertainty that we have pretty much all around. So what we are saying here is, number one, we continue and make substantial progress in withdrawing. We will have further rate increases in the future. So the normalization process continues. And at some point in time, we will have, of course, to identify the rate which will deliver the 2% medium-term target that we have. So the destination for us is clear. The exact pace will be determined meeting by meeting. And, you know, to do that, as I said, it will be data dependent and it will be meeting by meeting. But we will look precisely at 3 key factors, just to give you a bit of flavor of how we are going to work in the next meetings that we have. First, we will look, of course, at the inflation outlook, which takes into account the evolution of the economy, including the higher likelihood of a recession. So number one, the inflation outlook. This is what we are fighting. It's the inflation. That's the first one. Second is we will also take into account the measures that we have taken so far, because in the last 3 meetings, including this one, we have hiked by 200 basis points. And third, we will also be attentive to the transmission lag of monetary policy. And we know, as we do that, that any decision that we make is not going to have an immediate impact on inflation, but will be subject to the time lag that always affects monetary policy decisions. So that gives you, I hope, a bit of the flavor of the thinking and the rationale behind those decisions that will be made and those hikes that we will decide in the near future. I think you had a second question, which had to do with our balance sheet. So you covered it all in one question. Not all, because there are lots of other interesting and decisive matters that we discussed. Well, let us call it the reduction of our APP monetary portfolio. This is a matter that we have discussed at our last retreat amongst ourselves, governors. And we did not discuss the substantive issues today, deliberately, because we decided on a lot of issues. But what we decided is that we would pursue that discussion and we would decide the key principles of the reduction of our APP monetary portfolio in December. So that gives you a bit of an indication of when those key principles will be discussed, decided, and I will be very pleased to inform you about those principles at our next monetary policy meeting in December. And that has to be, of course, in advance of the decision to implement and to roll out this reduction. So.
Thank you, Madame Lagarde. And the next question goes to Joanna Bersace of CNBC. Joanna, please.
Hi, President Lagarde, thank you. 2 questions for you. The first is with respect to the neutral rates. You said at the last meeting, and this is a quote, "What I can tell you is that the further away we are, the larger the step we are taking, which is why we are front-loading now." Given that the deposit rate is now 1.5 percentage points, and the ECB have previously guided to 2% as being the upper end of the range of neutral, is it fair to assume that subsequent hikes will be smaller in magnitude than what you delivered today? That's my first question. And then my second question, I know it wasn't discussed in the statement, but it's about the anti-fragmentation tool, TPI. When you're looking at this tool and potentially triggering it, what is more important for the ECB, the spread level of a sovereign bond yield versus Germany, or the absolute yield level? Thank you.
Thank you very much for your 2 questions. I think what we decided is clear and straightforward. it's a significant rate increase, 75 basis points, twice in a row. And we decided to do that in order to pursue the substantial progress that we have to make in order to withdraw monetary policy accommodation. Our sense is that we have already made significant progress. As I said, we are not done yet. There is more ground to cover. And the question of what pace will be what will be the magnitude of future rates will be determined meeting by meeting and will be data dependent, adopting the review of the three factors that I have referred to earlier, which is roughly and quickly inflation outlook, the measures we've taken so far, and the time lag of monetary policy. So I cannot tell you much more than that at this point in time. I stand by my comment, significant progress withdrawing accommodation, more ground to cover. We have acknowledged that more rates are in the pipeline, but at which pace, to which level, I cannot tell you. I think we had a slight discussion about the how not necessarily helpful this evasive neutral rate is, and we decided to stick to withdrawal, completing that job, and then taking a step to decide whether we need and how much we need to go further. Because it is not by simply normalizing monetary policy that we will identify and reach the interest rates that is necessary in order to deliver the 2% inflation target medium term that we have. Your second question about TPI. We did not discuss TPI at all. And we have said, and I have said very clearly that in order to trigger TPI, we will look at a series of indicators, amongst which the spreads, the yields, but a few other indicators as well. And then we will determine if one country or several countries are or not eligible to TPI on the basis of criteria that I have also described for you in the past, which have to do with debt sustainability, macro framework, as well as fiscal policies. So that stands unchanged.
Thank you, Madame Lagarde. And the next question goes to Aude Kersulek of BFM Business. Aude, please.
Good afternoon, President Lagarde. So according to the ECB, at what point does fiscal policy, when it provides aid against inflation, run counter to monetary policy? Has the British case made a difference? And second question about a systemic risk that you are monitoring. Have you identified some financial vulnerabilities in our economy, and which ones? Thank you.
You know, I think in the present state of uncertainty, with the likelihood of recession looming much more on the horizon, and the probability of it having increased, everyone has to do their job. Our job is price stability. This is our primary mandate, and we are riveted to that. We are determined. All of us on the Governing Council, we are determined to deliver that price stability, which we have defined as the 2% inflation target in the medium term. There is no hesitation on that front. We, of course, have a dialogue with fiscal authorities. And when I sit at the table of the Eurogroup in particular with a colleague who are finance ministers, I explain the point of our monetary policy, which is to fight inflation and to bring it down back to the 2% in the medium term. And obviously they take into account their imperatives, but also the purpose of our mandate to reduce inflation. And I think that I must have repeated many, many times the famous triple T, which is temporary, targeted, and tailored, which from our perspective will help them address the needs of the most affected by income erosion and also by inflation, but without fueling inflation on a broad basis, because that would be utterly counterproductive in that it would require that we take harder monetary policy measures in order to deliver on our mandate. So that's the nature of the debate that we have. And, we are all attentive to what happens in neighboring country, in the euro area as well, and I think that the messages speak for themselves. You asked me about systemic risk. It's maybe I would turn it over to you, my dear Vice President, but I just want to remind you that the ESRB, of which I'm the president, has actually called the attention of all supervisors and regulators to the need to really focus on buffers and protection against potential risks. But please.
Well, good afternoon, first of all. Well, in 2 weeks, we will be releasing our financial stability review. And there, perhaps, the main messages that we are going to include there is first, there is a deterioration of the financial stability landscape in Europe. This has to do with the outlook, lower growth, higher inflation, financial conditions have been tightening. So we will refer to for instance, the situation of households, corporates, governments. The situation of the banks is positive. Now banks are much more resilient than they were, for instance, 10 years ago at the beginning of the financial crisis. But we have some concerns with respect to the non-banks. In the non-banks, taking into consideration the outlook, taking into consideration the situation of inflation, taking into consideration what is happening now in terms of financial conditions, then, we have to be very vigilant because we know perfectly that perhaps, in a remote corner of the financial system, we can have, a situation that could become difficult or complicated. And to amplify, the financial tightening that we have seen over the last months.
Thank you, Vice President, President. And the next question, now turning to WebEx, I would like to give to Balazs Koranyi of Reuters. Balazs, over to you, please.
Good afternoon, and thank you for taking my questions. President Lagarde, could you please unpack for me your statement that you expect to raise rates further? Because from the statement, the word several is missing, but in your reply to Carolyn, you used the word increases in plural. So just to be sure, are we looking at several more increases, more than one? And last time you gave us a number, 2 to 4 meetings. How does that number look like as it stands now? My second question is regarding telcos, because I'll be honest with you, having read your statement, it's not any more clear to me what you've done. The intention is clear, you want banks to repay early, clear, fine. But how? What are the numbers going to look like? I know a statement's coming in a few minutes, but if you could give us some numbers so I kind of understand what's going on.
Okay, I'm so pleased that you're honest with me. I want to celebrate that. So, joke apart. You asked me about the number of rates. And, in the past, I did communicate our intention to move towards the neutral rate as a first step in the normalization process. What I'm telling you now is that we have made progress on that normalization path, but that we still have ground to cover, okay? And as we have made those progress, I'm also telling you that the ultimate destination that we want to reach is the rate that will deliver the 2% inflation target in the medium term. And that rate, by the way, is not necessarily the rate at which we will have considered that normalization is completed. It may well have to go beyond that. But what I'm also telling you is that we are going to decide, meeting by meeting, on the basis of data and using the 3 categories of considerations that I have mentioned. So it might well be several meetings. Now, how several is that will be determined meeting by meeting. We know the path, we know the journey, we know the destination, which is not as clear as a figure that you would like to pin down, because we cannot do that. We simply cannot do that. We are not even in October at a meeting when we have a set of data that help us have projections, outlook for growth, outlook for inflation. We will have that in December, and we will take all these elements into account to determine what rate, by how much rate, will be increased. And we will see thereon, on the basis of data, on the basis of possible recession, if it unfolds that way, on the basis of inflation outlook, which will be influenced by that eventual recession, on the basis of what we have done, on the basis of the time lag. Then we will decide if at the following meeting, we also have to proceed along those lines. As I've said, the rate will be the one that delivers the 2% medium-term target that we have in order to deliver price stability. Well, on the second point, I'm very sorry that you could not read much into the TLTRO description that is included in the monetary policy statement. You will have, by the way, plenty of technical details as to how it works. But let me take a few minutes to explain to you why we made that decision. We made that decision for monetary policy reasons. Now, why is that? Because in the first place, when we modified the terms of TLTRO III back in the days of the pandemic, we made that decision for monetary policy reasons in order to incentivize banks to go contrary to what they would normally have done, which would have been to restrict lending. We wanted to support lending and therefore encourage them by offering terms that were very attractive. That was the monetary policy background against which we decided to revise the TLTRO III terms and conditions at the time. Well, in between, we have been utterly surprised by the unprecedented rise in inflation in a very short period of time that called for a change of our monetary policy stance. You've seen that. We've moved from negative territory before July to now the 175 basis point for the DFR. And we've done that because of the change of circumstances. Now, stance is one thing, and it's not enough. We need to have the best possible transmission. And that is the main reason why we are changing the interest rate. And I'll come to that in a second so that you fully understand the interest rate that will apply as of November. We're doing that to make sure that there is no obstacle, that there is no deterrent to the transmission of our monetary policy, and that bank will actually transmit the lending rates, which by necessity of our monetary policy stance are higher and have to be higher. That's reason number one. Reason number two, it is also going to reduce the size of the overall Eurosystem balance sheet, which also goes in the same direction as our monetary policy stance. And third, it is also going to increase the pool of collaterals that will be available going forward. And we know that this is a sensitive issue given the scarcity of such collaterals. But the key point is proper transmission of our monetary policy and elimination of obstacles that stand in the way of monetary policy. Now, I'm going to tell you in very simple terms, because you will find a technical annex which is fairly complicated. But in very simple terms, what we are doing is looking out to November 23rd. So it gives time to everyone to adjust and to be prepared. We are raising the special interest rate, which will no longer be the rate that applies up until November 22nd, unchanged. But from November 23rd onwards, it will be the DFR. That's what we are doing. In addition to which, we are opening 3 additional windows during which banks will have the opportunity to pay back if they so wish. That's what we are doing.
Thank you, President. And the next question goes to Jan Malin of Handelsblatt. Jan, please.
Hello, Madame Lagarde.
Hello.
I have one question on the forecasts in September. The ECB assumes a growth rate of 0.9%. Many economists are much more pessimistic. And a few days before the Governing Council meeting, several factors materialized concerning gas and so on. Would you say that it's fair to say that we are now in the downside scenario, which was outlined there, and assumes that the economy will go down by 0.9%, recession? And my second question is on the initiatives in several countries. Several governments have decided to take measures to curb the rise in the energy prices. What's your view on that? Does it help the ECB to fight inflation? Thank you.
Well, thank you very much for your question. So you're referring to the September projections that we produced at our last Monetary Policy Governing Council. And we had the baseline scenario, which for 2023 gave us plus 0.9, and the downside scenario, which gave us minus 0.9. And your question really is, are we already in that downside scenario, and are we not facing the likelihood of a recession in 23? Number one, we will know a lot better at our December next projection exercise when all the data are collected and we can offer you some new projections which will take into account all the developments that take place before the cutoff date. That will be shortly before the Governing Council meeting. That's point number one. Point number two, if you look at the downside scenario, many of the assumptions that we have made at the time have not materialized. So in the assumptions, we had a complete shortage of Russian gas. We are still receiving some Russian gas. We had assumed no substitution whatsoever. And we have seen in the last few weeks that thanks to the effort of the Commission, of various member states, there is a phenomenon of substitutions. We had assumed that commodity prices would continue to rise. And what we have seen is commodity prices declining, and for some of those commodities actually declining significantly. So we are not in the assumptions of the downside scenario. Is that to say that we are in our baseline? No, because there have been developments that are hallowed with uncertainty, but that are clearly, and we say so in the risk assessment in the monetary policy statement, which are clearly to the downside. And we will incorporate those risks if they materialize in our baseline in December, which will give us a chance to have a more accurate picture for both 22, 23, and 24. But, you know, when you look at the all the sort of intermediate indicators that we observe in between two projection exercises, there is a slowdown at play. Clearly, there is a slowdown. On the positive front, we see less supply bottlenecks. We still see very strong labor and all the numbers except the intention to hire. But other than that, positive. We see fiscal support in discussion at the moment, and I'll come to the end of your question on that front. But pretty much all other indicators are pointing downward. Now, you referred to some of the measures that were decided by member states in order to curb energy prices, which is, you will remember, contributing massively to inflation. You know, plus 40.7% from September 22 versus September 21. It's a massive increase and a significant contribution to the inflation that we are facing. I was going to give you a Normandy response, which is peut-être banque, non peut-être banque, oui, but that's not the appropriate way to address it. It is all going to depend on how it is designed, what kind of transfers are operated, and how transfers, if such transfers take place, are financed. And obviously, as we say in the monetary policy statement, we welcome structural reforms that will target the energy markets in particular. And we hope that these reforms can be led and developed by the European Commission for all European members, if at all possible. Thank you.
Thank you very much. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. I'm sure you've seen the comments by several European leaders, including the French president, the Finnish prime minister, and most recently the new Italian prime minister, who've all issued critical warnings about central banks pushing the economy into recession, crushing demand, and warning against these moves in order to salvage the credibility of the central bank and to fight inflation. What do you make of these remarks? And secondly, the markets are pricing in a further rate rises up to about 3% in your deposit rate. Do you think that's reasonable? Thank you.
Well, thank you very much for your two questions. On your first one, we have to do what we have to do. The central bank has to focus on its mandate. Our mandate is price stability, and we have to deliver on that using all the tools we have and selecting those that will be most appropriate and most efficient. That's what we're doing today by deciding a rate hike and by changing the interest rate of TLTROs going forward. Is that to say that we are oblivious to the risk of recession? Obviously not. And obviously we are concerned particularly about those who have low income and who are more vulnerable to not only the risk of recession, but to the reality of inflation. And when we fight inflation, we think of our mandate, but we think about those people who are suffering most from inflation.
That was ECB President Christine Lagarde from Frankfurt, Germany. We'll pick up on the end of that news conference in just a moment and bring you the latest headlines from it. We need to get to this opening bow stateside. Futures up 1/3% on the S&P. On the Nasdaq, we're down 1/3%. One big mover we'll talk about a whole lot more in just a moment. It's Facebook. In the FX market, euro dollar looks a little something like this, down 0.9%, back to a 99 handle on euro dollar. Big rally in the bond market in Italy and in Germany as well. In the United States, we're down 2 or 3 basis points. A break of 4% on a 10-year, 3.97. And a breakdown in Meta. Facebook around the opening bow, 10 seconds into the session, down by 24% on the West Coast. Let's get straight to Ed Ludlow. Morning, Ed.
Yeah, good morning, John. That's the biggest drop since February of this year. Takes the stock to its lowest level since January of 2016 and also takes its year-to-date market cap loss beyond $600 billion US. Investors are losing patience, and Zuckerberg is asking them for patience on the transition to the metaverse. Expenses for this year will be between $85 to $87 billion US, but grow next year to $96 to $101 billion. This is at a time where a number of investors and a number of names on the sell side have been saying, stop spending to grow this transition and stop the bleed out on the bottom line. And of course, they were also spooked by the forecast for the current period, which was that revenue would be between 30 to 32.5 billion US dollars as the advertising market globally softens. That's at the lower end of what the street was looking for in the previous forecast range. I thought was really interesting, John, in the context of this week, is on the call, Dave Wehner, the CFO, who has more of a prominent role now that Sheryl Sandberg has gone, gave a lot of granularity about what's happening in the global advertising market. They see more resilience in small advertisers, weakness in big advertisers, strength in ad segments, including healthcare and travel, weakness, including e-commerce, and financials. E-commerce, is that a forward-looking indicator from what we can expect for Amazon? If the ad market for e-commerce is weak, read through to the inflation in the consumer. And remember, for Amazon, which is to report after the bell on Thursday, advertising has been a surprise bright spot in recent quarters, a smaller part of their business, but I'm trying to tie all of this together in the context of what's going on in the global economy, and it's very hard.
This is a tremendous move lower. Let's just sit on it. We're down by 25% on Facebook. Microsoft yesterday down by close to 8%. Alphabet down by 9%. Those two moves, both of them, the biggest one-day drops we've seen going back to March 2020. And it's the resilience of the rest of the index that impresses me. If you equal weight the S&P 500, yesterday it was still positive. These concerns don't seem to be bleeding out to the rest of the market, Ed. What do you make of that?
Yeah, we know that in this early stage of the earnings season, investors are punishing those companies that miss on the top and bottom line, right? In Meta's case, I think this is a clear signal on this stock specifically. We've signaled to Zuckerberg and that management team what we want to see and what we want to hear on the basic discipline of operating expenses. It's important to say that actually Zuckerberg and other executives did say they're conscious of having more financial control, lowering operating expenses, looking at headcount in the longer term after 2023. But things are changing, right? And we went into this week, you and I, talking about how we knew the EPS for those big 5 mega caps was forecast to drop 22% year on year. But what if they surprised the market to the downside? Would projections going into 2023 change? There is now a question going into Friday, how much are we resetting expectations going forward, and how bad are things right now in the global economy?
Looking forward to the numbers after the close. Amazon and Apple coming up a little bit later on this afternoon. Ed, on top of that story. Ed, thank you, buddy, as always. Facebook, as it stands, 3 minutes into the session, this will be the biggest one-day drop going back to February of 2022 this year, but it will be the lowest since January 2016. Think about that, the lowest stock price since January 2016. Everything that's happened from early 2016 right the way through to the end of 22, and we've wiped out all the gains on Facebook. Meta right now down by 24%. A little bit earlier this morning, we had some data on GDP and other bits of the economy as well. On top of that is Mike McKee. Morning, Mike.
Morning, John. Well, we had some good news on GDP, the first positive growth this year, but it may not last because the underlying components are a little weaker than expected. 2.6% annual rate of growth in the third quarter. That's up from a 0.6% in the second quarter and a negative 1.6% in the first quarter. Consumer spending dropped off, up 1.4%. That was down. Business investment a little stronger, but a big drop in structures building held that back. Change in inventories was lower. That does subtract from GDP, but net exports is lower. The trade deficit got much narrower during the month. Exports went up, imports went down, and that means that overall that adds to growth. So what is the data telling us? Consumer spending weaker, business spending held up. Trade added 2.77% to GDP on a 2.6% GDP overall. Inventory subtracted 0.7%. Real final sales, half of what they were in the second quarter. Goods versus services shows that essentially we are recovering from the pandemic because goods spending is starting to go down, services spending is starting to go up. And John, you mentioned some of the other areas of the economy we got numbers on today. They tell us something about what's going forward. Durable goods orders, on a headline basis, okay, but core capital goods orders, basically business spending, down 0.7 in September, the last month of the quarter. And that suggests that business spending, which is one of the slightly bright spots in this GDP report, is going to slow down. Now the question is what happens to the labor market? Do we still need all those workers if we're not producing as much? Jobless claims not showing any change in the labor market for right now.
Mike McKee, forgive me for dabbling in a little bit of politics. The president on this GDP report, he says it shows the economic recovery is powering forward. At the same time, the McDonald's CEO said this morning that a mild to moderate recession in the United States is what he sees. Mike, what do you make of that? The commentary from the C-suite and the commentary from the White House.
Well, the CEO of McDonald's is not running for re-election, and so he can be honest. He needs to be honest. It's his fiscal duty to his shareholders. The president is not wrong that the economy rebounded, but it is not something, the details are not something that you'd want to brag about.
Mike McKee, thank you. The midterms within 2 weeks now. Mike McKee on the latest. Here's the latest for you in this market. 6 minutes into the session, we're just about positive on the S&P, up 0.4%. The Nasdaq down about 0.1% or so. If you looked at the Nasdaq, I don't think you'd guess that Facebook right now, Meta, is down by 23.5%. What a mess. Flowbank's Esty Dweck joins us now. Invesco's Alessio De Longis alongside her. To the two of you, thanks for being patient as we work through that news conference with Christine Lagarde. We'll get to that in just a moment. Esty, I want to come to you first. What do you make of the numbers we've had from Alphabet, from Microsoft, from Facebook overnight?
Well, there's clearly disappointment in the market, and I think there's additional disappointment because we've been so used to blowout earnings from most of these tech companies. Even during the pandemic, coming out of the pandemic, as we're shifting from goods to services spending, the big tech have delivered, barring one or two exceptions here and there, and now it's a couple of those big names disappointing. So I think in some cases, a little bit of an overreaction. In Meta's case, as was said previously, very much a signal that the metaverse investing needs to be reined in. But I think over the next couple of weeks, we'll see that some of these underlying earnings trends are still solid. They're not fantastic. They're not blowout, but they're maybe not as bad as the market and the immediate reaction is making it out to be.
But Esther, we've got to rethink what kind of multiple you put on a growth company that's not growing at all in some cases, and in some places not growing in any way, shape or form like it was in the years before. Esther, before, if you look back over financial market history, you always hear people say, stay long, be strong, over a 5-year period, over that time horizon, stocks will deliver. It's not unique, unheard of, to have lost decades in certain asset classes, certain parts of the stock market. Are you starting to think about that a little bit more with regards to some of these names?
Well, some of the price moves are starting to look like the lost decade for tech after the tech bubble or after the dot-com bubble. I don't think we're quite there yet. We're starting to hear some questions about what that next relay of growth for some of these companies are going to be. I think there's going to be a lot of a spotlight on Apple and Amazon coming, but I think it's still too soon to say that it's going to be a lost decade for some of these names. But more and more as we go forward, we're really going to differentiate, to your point earlier, between those that are growing and growing sustainably and those where we need to continue to readjust those PE expectations.
Alessio, you're not a single name man, but I can go through the numbers for you. Meta was a mess. Alphabet was about ad spend. You had the likes of Microsoft, that was about IT budgets. You had Texas Instruments, concerns about machinery, the industrial side of things in the economy. Alessio, when you look at things right now, what's your view on the US economy?
Well, my view is that this earnings season is like every earnings season. The actual earnings are more of a backward-looking indicator. We still need time to really digest the impact of interest rate rises and the tightening in credit conditions. Earnings revisions and guidance keep coming down. I think that is the more important data point and confirmation of the slowing that we expect ahead. I agree with Mike McKee, who highlighted, look at the durable goods report, look at the capital goods, look at the leading indicators of future growth. They're all rolling over. So with respect to the tech sector, you know, as Esty was mentioning, there's a lot of idiosyncratic stories, but we shouldn't underestimate at the broader sector level how much of the underperformance of tech is driven by the incredible rise in interest rates. Tech is a longer duration asset. But if the economy slows and if we can expect rates to peak here, we saw an indication of that with the ECB today, tech is still a sector offers quality characteristics, defensive characteristics, which obviously are only going to play out if interest rates peak. Tech is not the cyclical sector that it was back in 2000.
Alessio De Longis on the latest. I want to get to the latest from this McDonald's commentary that I keep going back to. The CEO about an hour ago said he sees a mild to moderate recession in the United States. Listen to this for commentary. Menu prices are up about 10%. US consumers are trading down from meals to value items. They're trading down on the menu items, and that trading down is coming from low-income diners. That's the reality of things for many people in the United States of America right now. I'm going to pick up on those comments from him on Europe as well in just a moment. I want to talk about Facebook. That is down and down hard. I want to talk about Credit Suisse as well. That has been absolutely hammered through the whole of this morning, and Swiss trading is down about 15%. We caught up with the CEO a little bit earlier on off the back of this big overhaul. Take a listen.
We want to go through the transformation of the next 3 years with a very, very strong capital base and leave the transformation also with a very strong capital base. It will become profitable definitely from 2024 onwards.
Shanali, what a tough day for that bank.
Truly tough day, John, and that's painful for the tune of $1.6 billion in market cap. That's how much has been erased after this restructuring plan was announced. Of course, some of this is because you're seeing that intent to raise $4 billion to fund this restructuring. They've also taken another $4 billion loss. So the numbers themselves are tough, as well as the plans for Credit Suisse moving ahead. Now, the plans go into 2025. They have given the plans for headcount reductions to the tune of about 9,000, with many thousands coming this year alone in the fourth quarter. You also have them starting to give you a general sense of the plan to exit certain assets. That idea of the investment bank split off is still very vague, but the idea is certainly there. And that idea that they're selling part of their trading desk to a group led by Apollo, again, how much capital does that release at the end of the day, and how much does it really help Credit Suisse is a big question. It's certainly a huge coup for Apollo and PIMCO, which is part of the investor group here. But again, details are still expected ahead, but a general sense of the plan here that has been trickling out for many weeks is now put in form, and investors are not so thrilled right now.
Shanali, I don't think anyone's thrilled if they held that stock right now, that's for sure. We're down 15.3%, just about holding on to a four handle on the stock. Shanali, thank you. For the broader equity market, 13 minutes in, we're up 0.2% on the S&P. We're down 0.4 on the NASDAQ. We've had some high-profile misses and some big plunges in this equity market. Think Alphabet and Microsoft yesterday, think Meta this morning. But if you go to the equal weight, you strip out the muscle of big tech, we're on for a fifth straight session of gains. And the S&P today on the equal weight S&P 500 is up about 0.8%. That's something we'll keep looking at. Coming up, we'll change track and go to Europe. The ECB President, Christine Lagarde, putting more hikes on the table.
We have acknowledged that more rates are in the pipeline, but at which pace, to which level, I cannot tell you.
That conversation up next.
The world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We have acknowledged that more rates are in the pipeline. The ultimate destination that we want to reach is the rate that will deliver the 2% inflation target in the medium term. And that rate, by the way, is not necessarily the rate at which we will have considered that normalization is completed. It may well have to go beyond that. We are going to decide, meeting by meeting, on the basis of data.
Forward guidance is dead, apparently. The ECB doubling rates to its highest level in more than a decade. President Lagarde signalling several hikes are still on the table. For more, Bloomberg's Maria Tadeo joins us out of Frankfurt. Maria, what did you make of that?
Well, Jonathan, what she says is the job of the central bank, the only job is to bring back inflation back to target. When you have 10% inflation, clearly you're off and you're not done hiking. What is different this time around is that she's not willing now to put a number of how many hikes to go the European Central Bank has left. Now, she repeats this will now be meeting by meeting. We're on a journey to a destination, but the destination, of course, depends on the date. And the way that this is being interpreted by the market is that perhaps you're now looking at a central bank that is less aggressive on the hikes, perhaps fewer hikes to come. The other thing that was key in this press conference, of course, are changing the terms of the TLTROs. Remember, these are the cheap loans that are issued by the European Central Bank. Of course, there's two reasons for this. One is they really want to begin draining some of the excess liquidity out there. And then secondly, this is not a good look when it seems that a central bank is essentially providing a subsidy for European banks. So they want an early repayment. She was not able to put a number on it. But of course, as you know very well, changing terms retroactively could mean legal action. But if you listen to that press conference, her message was clear. I think this is the right decision to make. And if you want to take on the central bank, well, good luck.
Maria, tremendous coverage as always. Maria Tadeo there over in Frankfurt. The euro negative off the back of all of this. Euro dollar just above parity. A break through that level a little bit early this morning. Look to the front end of the yield curve in Italy and Germany. Right now, yields big move lower, down about 20 basis points on a 2-year in Italy to 250. In Germany, down about 10 or 11 basis points to 182. And a 10-year briefly sub 2%, just above that level right now in Germany. Yields lower at the longer end by about 7 basis points. Esti Dweck, Alessio De Longa is back with us. Esti, the central bank's dilemma. Growth risk to the downside, inflation risk to the upside. What are they going to do with rates?
They're going to have to keep hiking, but I'm not sure we're going to continue to see 75 basis points as the benchmark. We saw it with the Bank of Canada a couple of days ago. She acknowledged that they've done a big amount already. They know there are lag effects, She mentioned that as well. But rates are going to go up. We're not anywhere close to 2%. They are doing things on the side to keep that price stability and that financial stability going as well, but they need to bring inflation down. It just seems that it's going to be, as she said, maybe more of a journey and maybe a slightly less aggressive one going forward. So 50 for December probably is what's going to be priced in by the markets, and you can see that in the reaction of the euro, that slightly dovish tone that's been interpreted by the market.
You addressed the dilemma, you teed up the trilemma, upside inflation risk, downside growth risk, and lurking financial stability issues. Alessio, that raises the next question. What do you do with the balance sheet?
With the balance sheet, you keep it stable for now. I agree with Esti. I think the next benchmark move is 50 basis points. At this point, the ECB probably has an incentive to take rates, I would say, to 250, 275 by June, September of next year. That's still a long way to go. Another 125 basis points on the deposit rate. Those are substantial moves. credit conditions are already tightening, as we saw in their survey, in their bank lending survey. So the balance sheet, you let the bonds mature, and you see how spreads behave in that environment. We need to address the monetary policy transmission and see how the economy really handles this meaningful increase in interest rates. I would also highlight one point. We do talk about inflation at 10% headline, and the ECB does target headline. But when you look at core, unlike the US and the UK, core is sub 5%. It's not at 6.5%. And that is your anchor, your leading indicator for where headline is likely to go, especially given that nat gas prices are rolling over hard and food and energy prices are volatile.
So let's put you on the spot. Last Friday, in the United States in the Treasury market, the 2-year peaked at 463, the 10-year at 433. This morning, the 2-year 440, the 10-year just above 4%. In Europe, the story's fading at the front end of the Bund curve. It's fading at the front end of the BTP curve as well in Italy too. Are you willing to say we've seen the peak in yields yet this year?
If you allow me a 50 basis points range, which with the current volatility, I think it's a bit of a concession that I can take. Yes, we think that this is an environment where fixed income yields are now offering an incredible opportunity. We haven't seen these yields since the pre-GFC. So plus or minus 50 basis points, I think we've seen the peak. So that means for Bunds, long end, 250, I would be a buyer of rates there. And for the US, between 4 and 450, I would be a buyer of treasuries.
Alessio, given the current volatility, 50 basis points is a one-day move. I'm not sure that range is wide enough. Alessio, it's good to catch up, buddy, as always. Alessio, the longest there, and SD Dweck off the back of the ECB decision. About 23 minutes into this, the S&P 500 down 1/3%, the NASDAQ down by 1 full percentage point. I talked up the equal weight S&P moments ago. I can tell you still just about positive, but only by 0.4%. After the close, Apple, Amazon, your trading diary, up next.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Little more than 25 minutes into the session, Facebook down by more than 20%. We talked about the resilience of the rest of the market yesterday looking at the equal weight S&P 500. Will that concern start to bleed going into earnings from Apple and Amazon after the close? Equities right now down 1/3% on the S&P, down 1.5% on the NASDAQ. That's the price action. Here's your trading diary. President Biden discussing the economy and plans for boosting manufacturing in America. 3:30 Eastern time for that one. Earnings from Apple, Amazon after the closing bell. A Bank of Japan rate decision coming up tomorrow. And we close out the week with a sprinkle of US data, personal income and spending numbers, core PCE, and the UMich Consumer Sentiment Survey. From New York, what a morning. What a day still to come. Thank you for choosing Bloomberg TV. This was the countdown to the open for our audience worldwide. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange